Just to cap the last bit, what we did last time, what we did was payment methods, if you remember. Okay. So in payment methods, we did documentary collection as the last thing. Of course, I won't go through the other two because one we did was advance payment or prepayment. Then we did open account, and then we came to documentary collections. There are four payment terms now: advance payment or payment, one called prepayment also. Then you call it open account. Then you call it documentary collection. Then the other one was documentary credits. So today we will complete documentary collections, then go on to documentary credits, and then we'll touch on little on the loans facilities available for trade. Okay, and then we will go on to Incoterms. Incoterms is a very is a technical term which you don't need to know in detail, but when you are talking to customers, when you're talking about knowledge of trade, when you're getting involved to discuss anything on international trade, Incoterms is also forms an important part. So, although you don't have to have very deep knowledge, I will go give an overview of Incoterms for you, which is very important. Right. Now, you remember last time I did the payment methods. First one I finished advance payment. What about advance payment? Who is at advantage? Who is at disadvantage? Right, I'll just recap. Advance payment means the person who is buying the thing, that is the importer, has to send the money to the exporter, that is the seller. So what was the consequence of that? If the importer sends the money to the exporter and the exporter does not ship the goods, then the importer is at trouble. Why? Because his goods are not come. So advance payment, the advantage is to the exporter. Why? He gets the money, then he only sends the goods. Because I told you, unlike in Cargills or supermarkets, Laugh Gas, wherever you go, right? In any supermarket you go in, you put your things in the cart, come to the cashier sees you, cashier is the seller, right? You're the buyer. So you see face to face each other, you give the money and you give the goods. So matter solved. But here the buyer and the seller, they cannot be seen personally, they can't see each other. They are at a distance. So there is a delay in the transaction. Either the seller gives the goods to the buyer and then the buyer sends the money. If you are talking in Singapore or India, we'll say if the Indian seller is selling some Indian saris, here he may have to send the saris to the Sri Lankan buyer. Once the Sri Lankan buyer gets the goods, he might pay. Or other way around, like in advance payment, the Sri Lankan buyer, he sends the money to the Indian supplier and then or the exporter and then he sends. So there is a gap. So in advance payment, what happens? The importer sends the money. He is not getting goods immediately, no. So he gets the goods, only the exporter gets the money. So therefore, there is a risk to the importer that exporter can take the money and keep quiet. So we covered that. That is okay. That payment method is good only if the buyer and seller okay. Then comes the open account. In that, what we do? In that, I told you, here the exporter sends the goods first. Right? Exporter sends the goods first and then he waits for the money from the buyer. That is the importer. So what is the risk there? The risk is that once the exporter sends the goods to the importer may not pay the money. So that risk. So in advance payment, exporter at advantage, importer at risk. In open account, exporter at risk, importer at advantage. Right? So sometimes those two are not compatible. One is good for one person, one is not good for the other person. Those two got together and they came on the documentary correction, which I told you. Just to run through briefly, you can see the signed sales contract. They sign the sales contract. And then what they do is, the seller, in document collection, seller will ship the goods right? And I told you about the three important documents that are required. You require the bill of lading, which is a title document. The importer has to go to the port and give to the captain to show that goods should be given to him. With that one, he can claim the goods. That is the document title. Invoice is the amount will say how much he has to pay the seller. And also, I told you, when you import goods, certain goods, there is a custom duty, right? Sometimes not all goods, depends. Say sometimes some farms like important medical drugs and all, there may be no duty. But there are certain items that you have to pay duty, custom duty when you bring it to the country. But that revenue is what we need, what the government requires to run the country, run the government, right? Run the country, like development, give free education, this, that, everything. They have to use that, right? So that's custom duty. So the customs, to ascertain what is the value of goods is importing, he will look at the commercial invoice, right? But there are other methods about valuation and all, they don't worry about that. But just assume that custom officer looks at the invoice and then decides how much the duty should be calculated and charged. So if the item is importing for $5,000 and the duty is 10%, then the import has to be $500 as duty. Just simple as that. Certificate of origin is to see from which origin this has goods have come. Like I told you, in the free trade agreement with India and Sri Lanka, it's very important that when we get goods from India and they say they want to apply it under the free trade agreement, then we have to see what is the origin of the goods, right? So therefore, we need a certificate of origin. That sometimes in most countries, that's a mandatory document required by the regulator when a person imports the goods. So I told you we'll take three documents, right? For example, the commercial invoice, the bill of lading, and certificate of origin. Now, in open account, the exporter ships the goods and sends the BL, invoice, and the certificate of origin direct to the importer, right? In open account, method of payment. So what he does, he has got the BL, he has got the invoice, he has got the certificate of origin. So what has he got to do? He has to only just go to the port, give to the captain, show the custom duty, pay the custom duty if there's anything, and take the goods out and go to his warehouse. And he can just keep quiet without paying the exporter. But he has got all the documents required from the exporter direct. That is under open account. But the difference here is he will ship the goods, right? But the certificate of origin, the BL and the invoice, he will send it through his bankers to the importer's bank. Okay, to the importer's bank. Clear? Yeah, right. Now, once the importer's bank gets the three important documents, that is the BL, invoice, and the certificate of origin, he will inform the importer's bank, will inform the importer, here there is three documents that come, the BL, the invoice, and the certificate of origin, for you to come and take it, pay the money first, and then take it. So we'll say, assume the invoice was $5,000. So the importer's bank will say, I told you Banda and Company, okay, Mr. Banda, you can come here, pay me $5,000, pay us $5,000, and you will have the BL and the invoice and the certificate of origin in your hand, so that you can take it and go and clear the goods. Unlike open account, he can't get those three documents without paying first. So once the importer comes to the bank, importer's bank, and pays it, then the bank will release the BL, invoice, and the certificate of origin to him, and then he can go to the port and clear the goods, right? So unlike open account, the importer can't go direct without paying and collect the goods. Now that's the difference between open account and document collection, maybe, right? Is given. Now he goes, he clears the goods in open account. But here he has to come to the bank, pay the money, okay, then take the document. Then what the importer bank will do? They will send the documents to the exporter's bank, and exporter gets the money. Money goes like this. Money goes like this. Here, money is going. Can you see? He brings the money to this bank. Money goes here. But can you see the numbering? He shifts the goods, number 2, right? Then he goes, instead of sending the documents direct here, he sends the documents here to his bank. Number 3, then number 4, it is sent. It is sent here to the importer's bank, and then from importer's bank, he will send it to the importer. After that, importer, now once this two takes place, this giving the documents to him and taking the money happens here at his bank, right? He comes to the bank, gives the money, takes this, and then it goes like that. Then the money then goes number 7, number 8, he has got the money, right? Right. So that is documentation. So here you can see the exporter won't lose money because he has, after shipping the goods, unlike open account. Open account, goods and the documents both go to the importer, he can clear and keep quiet. But here no, the importer can't do that. If he wants to get the goods, he has to come and pay the bank. So here it looks secured, like the buy is okay, he has got his documents, seller is okay, he's getting his money. Understand? Also, we did a thing called DA documents last time. If you all remember DA documents, which I will not go into again, where the exporter is giving a credit period for him. Okay, understand? Credit period, right? This is a credit period. Instead of, now he said to come and pay the bill, that is the document against payment. Document against acceptance means after the relationship they decide, and the exporter will give some credit, say 60 days. So he'll come, and instead of paying, putting money in the importer's bank, he will give a written undertaking or sign a bill of exchange and take the documents with undertaking to pay after 60 days or 90 days, whatever they agree the agreement, right? Then what happens? After that, at 60 days, what happens? He'll come and make the payment. Then the money will be sent after 60 days to the exporter. That is how DA works. Now the risk here is DA. In this case, if the exporter trusts the importer and gives DA terms, and if at maturity, importer doesn't pay, then what happens? If the importer doesn't pay, I told you, right? The importer's bank, get this point very clear, right? If at maturity importer does not pay, the importer's bank will inform the exporter's bank, and the exporter bank will inform the exporter that the importer has not paid, right? Not paid. Maturity came, you give 90 days credit. Importer's bank informs that importer doesn't have money to pay, right? So what is the course of action? Importer might have signed and given a bill of exchange, like I told you, right? Or he may have given a letter of undertaking that he'll pay, and if the importer is not paying, the exporter say, please send me that document to him, to the exporter, and exporter will sue the importer under breach of saying that he has not kept up to his undertaking, breach of undertaking, right? Now, of course, if he had signed instead of giving a letter of undertaking, if he had signed a bill of exchange, then that bill of exchange is a different financial instrument that is governed by the bill of exchange ordinance. I will not go into detail. So he will sue him under the bill of exchange ordinance. Okay. If he had signed, given a bill of exchange, signed on a bill of exchange saying that he will pay 90 days later. Now, all that I covered last time, right? Okay. Then I also covered one item in that, what is about avalization. Now this part which I am going to recap on what I did last time, right? I am repeating it because that will be very important for you to understand my next topic, which is documented credits. So let us get this part clear. Then it will be very clear for you when I talk about what a documented credit is. Right. Now we spoke about evaluation. What is evaluation? Evaluation is the exporter is giving credit to the importer, right? On not like the normal condition. Okay, exporter says, I'll give 90 days for you to pay. You pay me, give me a bill of exchange, or give me a letter of undertaking. That's it, right? Nothing to do. So bank, he's the importer's bank, he's the exporter's bank. We call this the remitting bank, this is the collecting bank. Okay, right? Then what we do is, so what happens here is, okay, now the issue here is, what happens here is, in evaluation, the importer's bank is not just taking the bill of exchange only or the letter of undertaking only. The importer's bank is also guaranteeing. The importer's bank is also guaranteeing that if the importer gives a undertaking to pay after a certain period, say 90 days, whatever credit period that the exporter has given, the importer's bank is saying we guarantee, the importer's bank is guaranteeing the exporter that since we have given credit to our customer for 90 days, we are additionally, when you give 90 days credit to the importer, what happens? Importer is saying he is giving undertaking, or he guarantees that he'll pay. Now, in evaluation, what is happening is the importer's bank is telling the exporter, you gave credit to the importer for 90 days. He has given an undertaking to you that he will pay after 90 days. Okay. But in evaluation, in addition to the importer's undertaking to pay after 90 days, the importer's bank is also giving a guarantee. Okay. Importer's bank is also giving a guarantee saying that if the importer does not pay, right? If the importer does not pay, the importer's bank will pay. That is what we call evaluation. Right. So now, if a exporter tells the importer, I am willing to deal with you only on DP terms. You have to pay me when I send the documents to your bank. By that, the exporter is getting self-assured that importer cannot get hold of the goods without making the payment. That's correct now. That's quite clear because the BL is sent to the importer's bank, and BL, the security and the commission sent to the importer's bank. So he can't take, importer can't take it without paying. Under DP, the exporter is feeling confident that no, not take open account. This man can't take hold of the goods without making a payment. So that is DP. Under DA, I am giving credit period. I am taking a letter of undertaking or bill of exchange signed by the importer. But at maturity, if he doesn't pay, what do I have? What can I do? Now, telling that he will pay at 90 days, exporter only told the importer's bank, give the documents to him. So gave it. Took the undertaking. Or bill of exchange signed. Undertaking of the importer is given. But at maturity, if the importer does not pay, then the exporter will not get the funds. So only way he can get the funds is by telling the importer's bank, please send me that undertaking that the importer gave, okay, or bill of exchange is signed, send it to me, and then he will sue it under that. That is the way he will get the money. But if it was evaluated, what happened? if it was avalized, if the exporter had given credit of 90 days to the importer, and if it was avalized if it was under avalization, what is happening? The importer's bank is also giving a guarantee. Not only the importer. Importer's bank is saying, look here, Mr. Ching, as we are avalizing this bill, if the importer does not make the payment to you after 90 days, don't worry. We are going to pay you. We are guaranteeing payment to you. Or we are undertaking to pay you, whatever you want to put it. Right? So now, just think of the status of a collection on a site basis. Site basis, no chance importer has to pay the money first, then only he can get the goods. Because he has to get the documents, go to the port, only from the bank. Right, that's okay. What is avalization? Avalization is, okay, exporter is giving credit, but, and the BL is given, customer importer is gone, he has cleared the goods. But on the 90th day, if he doesn't make the payment, the importer doesn't make the payment, still the exporter is secured. Why? Because his bank has given a guarantee. The bank has avalized that bill. Therefore, the importer's bank will have to make the payment. Okay? That's clear. So both is, whether DP, exporter gets the money, importer gets the goods only if he pays the money. In DP, importer can't get the goods without paying. That is okay. So importer doesn't get the goods unless he pays. If he pays, importer gets the goods, exporter gets the money. Under DA, what? Under DA, exporter gives credit. If the importer does not pay after the credit period, say 90 days, then the exporter will have a problem, because he'll only have a bill of exchange. He'll have to go and sue the importer and collect his money. But if it is avalized by the bank, then if the exporter gives the importer credit and the importer does not pay, then under avalization, the importer's bank has to pay. Now, this is very important. Get the clear concept of this, because this is very, very important to understand in my next item. We will cover it, document credit. Right. So, in your thinking, you might think documentary collection on a collection basis, right? And which is the basis is DP, documents against payment. Or if it is on credit terms, if it is on an avalization basis, the exporter will get his money. That is how you might be thinking. Am I right? You all are thinking, yes. If it is DP, importer can't get the goods without paying. If it is DA avalized, still importer gets the goods, but does not matter. If he doesn't pay, the bank will pay. Right. Now, if a customer comes to you and tells you, give me some money, give me a loan. Say he's an exporter, give me a loan to buy some handicrafts from outstation, because I want to export. How are you going to export? What is the payment terms? What is the payment method? They say on a DP collection basis. So I buy the goods. So you say he wants 100,000. Say you are selling dollars. He wants $10,000 from you. Equivalent rupees goes to you, right? So you give him a loan for $10,000 equivalent in rupees, right? He goes and buys the goods from outstation somewhere. We'll say comes and sends the goods, exports the goods to the importer on a collection basis. He does this. He sends it, okay, and then he goes to his bank. This is in Sri Lanka. He's the exporter. He comes to the say whatever bank in Sri Lanka, and then gives the documents. Documents go to the importer. You say in Saudi Arabia or something like that, right? Okay, he's a buyer, so he has given the document gone there. So the Saudi buyer comes and pays to his bank, and his bank sends the money to Sri Lanka. Right. So this I'm doing DP. You don't worry, you get your money because the moment I send the documents to the bank, the Saudi guy cannot get the goods without paying the divide. So therefore, I can pay your money back. Then one proposal he gives you. The second proposal he gives you is, so I'm going to do it on DA basis, right? DA 90 days basis. Then the bank tells DA 90 days. What if you send the goods on a DA basis and 90 days later the buyer does not make the payment? Then your customer is saying, I looked into that. I knew you were going to ask me that. I looked into that. And I have agreed to work on a DA basis subject to avalization. Unless it is avalized, unless it is on avalized basis, I will not agree. So he says, I will send the goods to the importer, give him 90 days credit, right? And his bank, as it is going to be avalized, his bank will guarantee payment so that after 90 days, if the importer does not pay, the bank will pay. Now, these two proposals are given you. Of course, beforehand, the importer will send a message. The importer's bank will say the importer, Saudi, will say the bank, HSBC Saudi, right? Will send a message to assume People's Bank saying that your customer, Mr. Banda, is trying to export some handicraft to our Saudi guy, right? Mr. Ali will say, okay, Ali in Saudi Arabia on a DA average basis, right? Or we'll say first one on a slightly straightforward, you have to pay anything on an average basis, and the Saudi importer's bank will send a message to the exporter's bank and say, tell Mr. Banda that he can go ahead and give credit to our customer, Mr. Ali and Company Director. And if Mr. Ali does not pay you after 90 days, we will pay you. Who is saying it is all. So now even if he does it on DP, okay, he's getting the money. Now if it is DA, here again the bank is guaranteeing the payment to the exporter. So the exporter now sees, if I give DA, I'm going to do one avalization and bank is guaranteeing payment. So with the money you're giving me, I will go and buy the goods. Say go to Candy or somewhere. Candy, I'll buy the goods, ship the goods, send the documents to the Saudi HSBC. They will release the goods on a 90 days DA basis, and also as the HSBC said that they are willing to avalize, they will after 90 days, even if the importer does not pay, the bank will pay. So when the bank pays me, I'll pay your loan. So the bank manager, yeah, DP if I give, he can import the goods, send the goods, the buyer can't take without paying. So anyway, the money will come. And our customer can pay the loan. Banda can pay the loan. If it is DA avalized, yes, still he is giving credit, okay, right? And then After the period, when maturity comes, even if the importer does not pay, his bank, it is Saudi, has undertaken to pay. So therefore, again the exporter will get the money. So it looks good. Both ways, the importer can't get the goods without payment or without giving a guarantee to the, without his bank giving guarantee. Bank giving guarantee means anytime you can drop the money, right? That's what the. So both ways, you as a People's Bank or will say whatever bank in Sri Lanka, that manager will think yes, the document collection, DP, okay, yes, import has to pay the money. When he come to me, then he can pay the loan. DA also, let's say 90 days, whatever we said, 90 days, that's also okay, because at maturity, if the importer does not pay, then the bank is paying me. Bank will pay our export and export can pay the loan. So it looks good. Just to deviate slightly, if it's your bank and your customer wants to deal with his importer on a avalized basis, right? What are you doing? You are giving a guarantee to the exporter saying that if you give credit to my customer and he doesn't pay you at maturity, I am going to pay. So that will be an exposure to the bank. Okay. So that means we don't know whether he'll have one bill. Today he might say 90 days. He gives you one bill. Then tomorrow, no, the bill is going to be 90 days later. No. So he'll be having some more shipments to do different buyers on the same basis. So he may have another bill. He may have another bill on all levels. So therefore, he might at any one time maybe he'll have about up to about $100,000 bills on avalization, right? So for that, you have to estimate his needs and set up a limit for avalization limit. When you're doing the proposal, credit paper, whatever, if this customer wants this facility, you will have to set up a facility called avalization limit. You just can't say, okay, you can guarantee. Then where do you show exposure? One day we'll have to pay. No, if the importers pay, you have to pay. True, you're not given a loan in real terms, like you're not advance money, but an eventuality will come that you may have to advance the money, pay the importer. Then the customer will owe us, right? So therefore, it becomes a exposure to us. So if it is exposed to us, we'll have to have a facility for the customer. So you have to estimate and see if this customer is dealing with other buyers also on avalization. Today, one buyer, he gives 90 days. Today is the 19th of September, October 19th, November 19th, December 19th. So this 10,000 undertaking you given, you have booked it in this facility, will be outstanding till December 19th. But in the meantime, he may have some more buyers where he ship goods, and they also have avalization. So their 90 period might go beyond that. So then tomorrow he brings a bill for 90 days, then at that thousand, another $15,000. Then 15 plus 10 is still not paid, $25,000. They have to bring another $25,000, then $50,000. So like that, you have to estimate the requirement and set up a avalization limit. Okay. It's a facility actually we are giving. The moment we open our mouth and give an undertaking to somebody, it's an exposure. So if it is an exposure, then we will have to have a limit. So in your setting up your paper to the for facilities, you may have to also include a avalization limit for this customer. Right. Now coming back again. Coming back away from the credit part of it. Now we see DP document payment, okay. Importer can't take the goods or paying. Avalization, yes. Even if he gives credit and he doesn't pay, the bank will pay. Right? So, what is the advice we give? Is it safe for him? What will be the concern? You'll ask the customer. You are asking, yes, here's a confirmed order from the exporter. What is the exposure? What is the risk? You'll ask. Or you'll see what is the risk you see on the system. The method of payment is document collection. So what is the risk? You will ask the customer, okay, my friend, what you have told me is quite convincing, but I want to ask you one question, my friend. Will they, Mr. Banda? Now you are sending the goods over here. Right? You are shipping the goods. The goods are going to Colombo. Right? Okay. And it's on DP terms, document against payment. Right? You are sending the documents to the bank, HSBC Saudi. Mr. Ali, I have given a loan for you for $100,000. You take a loan for me, or whatever, $10,000, $100,000. You are thinking of paying me. How are you going to pay me? You will ship the goods to the importer, then you will go and give the documents here, right? Once the importer pays, you will get the money from this bank and you will pay me. What my concern is, Mr. Banda, what happens if you send these documents here to HSBC Saudi and Mr. Ali tells he doesn't want the goods. He doesn't want the document. He doesn't want your BL. He doesn't want your invoice. He doesn't want a certificate. Then will Mr. Ali pay the money? Common sense, no? If he takes the BL, takes the commercial loan, takes the he can go and clear the goods. But he has to make the payment. Right. So if he doesn't take the BL invoice and everything, he won't get the documents, he can't get the goods. But he's saying at this point, when HSBC informs Saudi informs Mr. Ali, Ali says he doesn't want to accept the documents. See? These documents, he sees and says, I don't want the documents. So if he doesn't want these documents, and if that means basically saying he doesn't want the shipment, he doesn't want the goods. That's what he's saying. Then he says, if he doesn't want the documents, obviously Ali won't make the payment. If he doesn't want it, why should he just make the payment? He's not doing charity, right? So he won't make the payment. So if he doesn't take the documents, he does not make the payment, then will Saudi get the money from him to pay? No money coming. Then this won't happen and this won't happen. Then the loan you gave will be outstanding. You understand? So then you will ask him, Mr. Banda, now you are doing all this. What if your importer Ali says he doesn't want the goods and he doesn't take a document? How will you get your money? You see? So there is a risk. Now I won't go into detail about, I said no, there is an agent, right? Case of need, all that I did the doctor. So don't forget, he'll not sell the goods in Sri Lanka, find a market, all that part I finished, right? I don't tell all that, I won't go into that. But you saw the risk. The risk is that if Ali does not take the documents, then the payment will not come to the exporter. So if the payment doesn't come to the exporter, then he can't pay your loan. Right? Please, I think you all are very knowledgeable and of a certain level. Don't give me that answer that if he doesn't pay, if the exporter doesn't pay, we have taken a mortgage on his house, we will sell his house. Right? That is the last thing that you should think of. You won't tell the customer, Mr. Banda, you better do DP, you better do DA, you better, I'm not interested. Can you mortgage me on house, 100 million worth house, I'll give you 10 million. So you take our money and do whatever you want, I'm not interested. That is not the way a banker works. That is working, you get in, never seized it, pawnbrokers, right? You go and give the gold, he doesn't care what to do with the money. You take the money, go to the next liquor shop, doesn't matter. But you give me gold, I'll give the money. What you do with the money, I don't care. That is not a banker, no. That's a pawnbroker, right? Okay, that's how they work. Or not really pawnbroker. Anybody give the goods, we give the money, right? That's not way banker works. And here, so before thinking of taking his house as security and mortgaging house to you, that is not the way bank looks. Bank looks at the viability of the operation. Whether the loan is taken, the purpose is taking, is able to repay. Repay means not by way of security, by his purpose, by the purpose is taking the loan, whether he is able to pay back from that by utilizing, by achieving his purpose. That's what you see. So therefore, in this case, if the exporter does not pay, he will not have the money to pay you. Correct? Is that clear? There's a risk. Now you know there's a risk. Now what do you do for that? In the second scenario, now this is very important. This is you will be wondering why I am emphasizing on this part. Because this is what is relevant to the next part, right? In the evaluation case, see what happens. You gave the goods. Evaluation is the condition. Customer does not pay, bank will pay. Therefore, export will get the money. That is how you think. So you will be willing to finance with the customer? No, customer. DP, what happens if he doesn't take the goods? Then you don't get the money, no. You go and give credit to the customer. Better for you to give the credit to the customer and tell him to do it on an evaluation basis. Because you give him credit and you give credit on an evaluation basis, then what happens? Then the customer will get the bank to guarantee, and therefore if the exporter does not pay, you will get the money. So if you want that, then the customer knows I am doing on DP terms, document payment, I might get the money fast. No. I'm not worried about getting the money fast. You want the loan for 2 months, 3 months, 4 months, I will give you. But I want you to go and give it on credit basis. Why on credit basis? Because give it on credit basis, give the credit on an evaluation basis. Because if you give the credit on an evaluation basis, the customer will get the bank to guarantee payment. Don't you see exporter, Mr. Banda? Then you get the money. So give the customer credit. Tell him evaluate. Then you are sure of the money. So you are dealing with him on a DP basis. I am not happy because he may not take the goods and say don't. But evaluation basis, if he doesn't pay, the bank will pay. You see my point? So are you going to encourage a customer to go and give credit when he can get the money straight away on a side basis? When the customer exporter is willing to pay money immediately on a DP basis, are you going to tell your customer, no man, you go and do on a credit basis, credit evaluation basis? The bank will guarantee. Good for you. You're sure the way. Now, is that a good advice to the customer? Is the risk the risk you had no DP, that okay, DP maybe, but if it doesn't take documents, it doesn't pay. Is that risk covered under evaluation? Right. Now listen carefully. Okay. We'll see what is whether that statement, that recommendation the bank manager give is right. Okay, documents sent here. Right. 90 days credit, documents are coming here, documents are going here. Mr. The bank manager HSBC informs Mr. Ali, come and take your documents. DA basis, 90 days, evaluation, come and take it. We have to guarantee payment to the exporter. Come soon, right? But Mr. Ali says, I know he doesn't want money at once. He wants it on a 90 days basis. He's a good guy. He's going to be credit. But even though it is on a credit basis of 90 days, which the bank, you're going to guarantee him payment, I am telling you, I don't want the shipment. Even on a credit basis, evaluation we don't want. No, I don't want. Same story here. Now in a DA, what happens? What will this be? This will not be money, but this will be a bill of exchange undertaking, right? In DA, it will be not, what will give you is not a money, but a bill of exchange, right? Or letter undertaking. We'll just keep it bill of exchange. So why is in the DP, if he is not taking the documents, right, he is not going to give money, correct? In a DA, if he is not taking the documents, right, listen carefully. If he is not going to take the documents, is he going to give a bill of exchange? Why should he give a bill of exchange undertaking that he'll pay at 90 days if he's not getting the goods? If he's not taking the goods, he's not doing charity. Like I said in the first case, he will not give the bill of exchange under DA, right? Because he doesn't want the goods. Under DP also, he didn't give the money because he didn't want the goods, right? Now you say, no. Under DA, if he doesn't use the bill of exchange, does not matter. Evaluation bank has to pay. That will be your understanding. Very important, okay? Now, again I'm going back. What does evaluation mean? Exact meaning of evaluation, right? Let me go to slide. What slide number? Right. See this. Payment undertaking can receive bill of exchange drawn by a way of giving a security to the drawer for a term. It has worth such evaluation, right? See, evaluation of a bill of exchange is in effect a bank, usually important bank, joining in the acceptance of the bill. Joining. Right? So we must join. Joining in this case, it is joining in the, it is joining in, right? In this case, it is, what it means is, this bank, once the bill of exchange is given, he gives a bill of exchange saying, I undertake to pay, right? In what he had said, he gave first, he says, I am undertaking to pay. Then the bank will join with the import and say, yes. In addition to him saying that I am willing to pay, I will pay at maturity, we are joining and saying, we will guarantee that if he doesn't pay, as he has undertaken to pay. He has given you an undertaking to pay, no? If he does not pay, keep to his undertaking, then we will pay. So, now see the situation. He doesn't want the documents. Right? He doesn't want them. Then, is he going to give an undertaking? Will there be a bill of exchange? Right? There will not be a bill of exchange. Because he is not giving a bill of exchange. So, what does he want bill of exchange? He says, I undertake to pay you on 90 days. right? Now, if he is not giving a bill of exchange, saying that I will pay after 90 days, what is there for the bank actually join? Join what? When the importer has not given an undertaking, how can his bank, how the join? You see the fine difference, the fine real meaning. So similar to the DP document, if the importer does not accept these documents, then he won't give an undertaking. He won't give the bill of exchange undertaking to pay, right? So if he doesn't give the bill of exchange undertaking to pay, then it says we can't join. Clearly listen. Evaluation does not say you send the documents on a DA basis to our customer, we will pay. They didn't say that. You do the shipment to our customer on a DA basis, we will pay. That is not what HSBC Saudi said. HSBC Saudi said, you send the documents, you do a shipment on a DA basis and send it to our importer, and when he gives you an undertaking to pay, when he has given you an undertaking to pay, and if he doesn't keep up to his undertaking, then we will pay. See the difference? He did not, the bank, Ali did not say, the HSBC did not tell, you ship the goods to Ali, on a DA basis we will pay you. No, that's not what he said. That is not what the bank said. Very clear. You may explain to your customer, look here my friend, when you say evaluation, you explain to him DP risk, no. You can send the documents, DP, he has to pay and take. If he doesn't pay and does not take documents, then goods are stuck in Sri Lanka. Right? That's done. Now we are saying, if you say evaluation, you tell the customer, my dear friend, if you send the goods to Sri Lanka on a DA basis, just because you ship the goods to the import on a DA basis, right? That does not mean the bank will pay you. No. Just because you ship the goods to Banda or to Ali on a DA basis in 90 days or whatever, bank is not saying they'll pay you. They are only saying you send the documents, do a shipment, send the documents on a 90 days DA basis to the exporter, to the importer, right? And if the importer takes your documents, accepts the shipment, and then gives an undertaking that he will pay at 90 days, and then he does not pay on the maturity, then only we join in that guarantee. We are joining his guarantee. So for us to join his guarantee, first he must give a guarantee. If he doesn't give a guarantee, how to join? Nothing to join. Right? He must accept the goods, give the undertaking, then only the bank will join. So if a situation comes, whether it is DP site or whether it is documents against acceptance evaluation, right? And where a situation occurs where the importer is not willing to accept his shipment, that means not willing to take the documents, then he won't pay cash under DP and he won't give an undertaking under DA. So if he doesn't accept the shipment and does not give an undertaking, then HSBC Saudi can't exercise the evaluation, because the evaluation means we are joining in the guarantee of the importer. Importer, don't join. I'm not giving any guarantee. I'm not taking the documents. I'm not taking the shipment. I'm not giving guarantee. Now do you see? You saw the risk. Even under documents against payment or even documentary on a DA basis evaluation, still the prime factor remains, is the importer willing to accept the goods? That risk is there. You understand? Is the importer willing to accept the goods? Right? So that risk, either in DP or in DA obviously can say the paying or something else, DA averagization, where the bank is a guarantee, all depends on whether the importer is willing to accept the goods. If he is not, under DP, he won't pay the cash. Under DA, he won't give the undertaking. Therefore, even on an annualized basis, the importer's bank will not guarantee payment because there is nothing to guarantee. Importer is not given undertaking how to join because he is not taking the goods, he does not. Now, I hope you all understood that very clearly. But if you have got that finer point well, then only you will understand what is documented credit is. Okay. So let us now, before I go to documented credits, let us go through a little of these collections I told you. There are, like I said, all the countries are joining in, and then there will be interpretation, all that, all this. So there are also rules for like under what for common rules which all countries have subscribed to and say, okay, whatever decision we will take according to these rules. And the rules for collection is ICC publication 522, right? They'll put when you send the say when the exporter sends the documents to the importer's bank, on that day on the letter they will please note that this transaction is subject to ICC rules 522, right? So there are 26 articles. I can put some of them. Some of the main articles are here. Like who are the parties, the principal, the bank, exporter's bank, right? Okay. Right? Then collecting bank. Okay. All that, right? Okay. And these are not, you can see this. Yeah. Case of need, I did all that day. Evaluation, I told you, right? These are the articles I'm at the highlight, but I don't think I need to go through very detailed. Now, for example, this is a simple one, right? When whatever payment done, okay, what this article basically says is, whatever this article says is that, now, can you see here? Now he will ship and send the documents now. Right? Whatever the document he's sending, right? He's sending. So he's sending whatever he sends the documents here. Now this is supposed to be BL, supposed to be invoice. Now we are not going to see once he gives the document, we will not go and check whether now say DA means we will not go and see whether the document the ship has come. Banks will not go and see whether the goods are the same. BL says 5 cars, right? Or 5 toys, 5 bulldozers. Now, bank will not go to the port to check whether actually bulldozer come, whether bulldozer damaged, bulldozer good, nothing. Whatever you're doing, I told documentation, inspection certificate, all that bank deals only documents. Huh? Importer has been told, look here, my friend, you are taking the BL, you come here, you pay the money, you're taking the documents and going, you're going to the port, and you go to the port, and if you find that, oh my God, instead of cars, you have sent bicycles, that is not the bank's concern. The bank doesn't deal in goods. That's what that rule says. Huh? Basically, is what it is. Okay, right? Goods are, and also I'll tell you about this. You know, when you call it BL, right? These are saying that when you're putting when you're giving the documents. For example, these are articles. I don't think that you need to worry too much about. Okay, so when you talk about documents, right? Now these all will be dealt only in documents, right? Now, can you remember I told the BL? The BL will say not to whom to release. Now, actually, I'm not. I just given in just give for you a brief. Not so important for you all. They are saying that you know like the BL can the BL will say whom to deliver, right? It has to be to the exporter now. But if the exporter is sending a BL, deliver to the bank and tell the bank to keep the goods and give it to him, that is not allowed. You can't send goods to the name of the bank. That's what it says, right? This article. Yeah. Goods should not discharge to the bank. Understand? The article, but anyway, your main article is you think of case of need. This is the main item, okay, for you to know. I have to explain to you how they appoint agent to go and clear the goods and what and how the powers of the collection instruction clearly fully indicate the powers of such case of need. In the other in the case, the banks will not accept any instruction from the case of need. That I did last week and evaluation. These are the two main items. Okay. Right. Now we come to documented credits. Okay, now what is this? Now do you see advance payment there is a shortfall. Open account there is a disadvantage, 50% one side, 50% another side, right? Then you come to collections. Because collections solve the problem, I told you. What is importer doesn't accept the documents or the goods. The importer doesn't accept shipment, you are finished. Then that was your loss. Right, that is also loss. Now, that is why I said there's another thing called documented credit, right? This is a bit more technical than collection. Collection is straightforward. Send the document, give the money, get the money, you send to the bank, right? This is a bit more technical, but like I told you, I will sufficiently cover it so you get to absorb the core understanding what documented credit is. That is more than enough for you. In this case, what is the documented credit? Documented credit is an undertaking given by a bank, issuing bank to the seller at the request and on instructions of the buyer applicant to pay at site or at a returnable future date a stated sum of money against compliant presentation with documented credit conditions. Oh my God. This is totally complicated English, right? Just can't understand. This is going to be very, very difficult. It's going to be really tough, right? That's how you're thinking. No, it's not so, right? All the wording is there, but understand the words. Undertaking given by the bank, obviously, can you understand? To the seller, right? By the bank was issuing the undertaking. Given the bank means the bank that is issuing the undertaking. To the seller, that is the beneficiary means who is being given, who is going to benefit by the undertaking? The seller or the exporter or the beneficiary, calling the beneficiary. At the request on instructions of the buyer. Who is going to ask, telling this, what is this about? To give the LC, going to told by the buyer, right? Okay, so to pay at site means immediate to pay or determined future like a DA at a later date, right? Compliant presentation. I'll tell you what this compliant. I'll explain to you with documented conditions. So this is what happens. Let me go to this. Simple as it. What happens here is the import and exporter, we have left out completely advance payment and open account. This is can't. No, nothing. Don't talk about. Documented collection, they discuss the exporter says, now see, in documented collection, I am telling you, whether it is DP, you are paying against site, or with the avalization, both no point for me, the exporter says, because why? If the goods go to Colombo and the goods are sent to you, and you will say, I don't want the goods. Then what do I do? No point for me. No point in my sending documents to the bank. No point telling the bank to avalize. Bank can't avalize if you don't take the goods. Bank can't pay. You won't pay the bank if you don't take. If it's DP site, you won't pay the bank. I won't get the money. If it's DA of course you can take and cheat. That's different. But even if DA avalization, the bank undertaking won't come to me unless you take the goods. So what is the use? I still run the risk of not getting the money. So let us deal on documented credits. Right. Now what is the difference here? What is this so-called thing that is going to help this problem solve? One thing you should understand is basically what is the problem in document prediction? If the importer accepts the goods only, whether it is DA or de-evaluation, the importer will get the money. The exporter will get the money. Right? Only if the importer accepts the document, the goods, the shipment, that the exporter can get the money or the on a DP or DA basis, on a DA evaluation basis, right? Right. So what is documented credit? So documented credit means that was the last part I told you very clearly. Documented credit means that even if the importer does not accept the shipment or the documents that you send, even if the importer does not accept your shipment, or in other words, does not accept your documents, either DP or DA, still you will get a payment because the bank is going to give you a guarantee. So that is what you call document credit. Simple as that. Irrespective of whether the importer accepts the shipments or accepts the documents, the exporter will get the money. Okay, now you got it clear. Right. Now you know the rule. How does it happen? This is how it happens. You sign a sales contract, okay? Right? The importer goes to his bank, right? And tells his bank, my exporter, Mr. Ching will say in Singapore, I think it's Banda, right? My exporter, he is not willing to work on anything other than a document credit, right? Which means that the exporter is telling his bank, give the exporter guarantee. Give the exporter guarantee, right? He's telling his bank, sir, please give the exporter guarantee that if he ships the goods to me, okay, if he ships the goods to me, you will pay. Move the bank. He's telling the importer. He's the bank. So he's telling the bank, tell our exporter to ship the goods to me, right? And if he does that you will pay him. Now see. Now do you see what it says? Right? What it says? Here, the exporter has only got to ship the goods. Okay. He is not concerned whether the importer will accept the goods, not accept the goods, not take the goods, or whatever. That's not his concern. He will only do the importer's bank will give an undertaking. So what is he got to do? He has to manufacture the goods or whatever is manufactured or ready-made or already finished goods, he can export it direct, right? Otherwise, once he gets the undertaking from the importer's bank, right, then what he has to do is he manufactures the goods, if you have to manufacture, and then ships the goods. Ships to him. Okay. The moment he has shipped the goods to him, right? What will he have? He'll have the BL, he'll have the origin and the commercial invoice, right? Okay. Now, when the importer's bank writes to him, right, and tells, look here, my friend, Mr. Ching, you ship some goods, let's say toys or whatever to our customer, Mr. Banda and company, right? We will pay you. So what they're saying is, in that letter, whatever importer wants, right, within regulations, of course, with the permitting regulations, wants, the importer's bank will put into that letter to him. It might say, please ship the goods on before end of November. One country. He wants it before end of November. Right? Ship the goods on November. And also send me a BL. Send me the certificate of origin. Send me the invoice. Of course, you're going to say invoice. Because you bill that will give it, right? Send me an inspection certificate from SDS. Send me a packing list. Send me a wait list. All that he'll put. So the bank is saying, you read our letter, what is our undertaking letter to you, right? And see what and what we asked you. You comply with that, then we will pay you. That letter that the issuing bank sends to the exporter is known as a documented credit. It is also known as a letter of credit, right? It is also known as a letter of credit. It is also known as a letter of credit, right? Documented credit or letter of credit. Then, so now what happens? Who is writing to the exporter? The importer's bank. We say HSBC from say this is China and the Sri Lanka People's Bank. I mean, sending a letter, right? Sending. So what the People's Bank doing is issuing a because it is issuing the letter, it is known as issuing bank, right? Issuing a letter to the letter means letter of credit or a document credit. I told you that item is known as what it is. To the exporter, you ship the goods and submit the following documents: BL, invoice, origin, we will pay you. So what he has to do is, now see, before he starts doing anything, he has got an undertaking. Once he has got this undertaking, the exporter has settled his undertaking, right? He will then start manufacturing and producing, right? And he has to ship. Now that letter that he got, or the letter of credit or document he got, says ship before 30th of November. I won't go in detail of what a document is, right? The conditions and all that, not necessary. Okay. Let your trade department to handle it. What are the requirements, they can fill it, right? You don't have to go all that. Then, once that exporter ships the goods to Sri Lanka before the 30th November, say 30th November, right? Ships it, right? And he goes to the bank and gives all the documents that the People's Bank is asking for. He's giving the BL, the commercial amount, he's giving the origin, the packing list, his weight list, all that is given, right? And then what will happen is, he will come here to People's Bank. Right? We'll say his bank is in Singapore Standard Chartered, right? Comes here. Once it comes here, the people are going to check and see. We sent him a LC. What did we say? We told him that we want goods to the value of $10,000. How much has he put the bill for? $10,000. All right, okay. That's fine. $10,000, right? Okay. He has not gone beyond that. It's not 11,000, right? 10,000. Then we have told him that the shipment should be done before 30th of November. So the BL, what he has got, right? The captain has given the receipt that he got the goods for shipment. Yes, he has given the captain. The date is 25th of November. So that means it's done before 30th. That's done, right? Where is the packing list? Right, okay, it's there. Where is the inspection certificate issued by SDS or Bureau Veritas? We said we want one of the other. It's there. Okay, right. So then certificate of origin is there. Now all documents, he has submitted all the documents required through his bankers to people. Also BL to say that he has shipped the goods. Right. Then, but that does mean, what does it mean? He has complied with the conditions of the People's Bank LC. Therefore, once the People's Bank gets the documents to show evidence that he has complied with the letter of credit, People's Bank has to pay. Right? Now, here, understand, the bank only says he has to ship the goods before 30th November. Now, you normally don't put to say that the goods should arrive in Sri Lanka before 30th. Sri Lanka board goods, because once he hands it over to the captain, right, logically, there will be no trade taking place. If you say you must ship the goods to Sri Lanka and our importer must, our Mr. Banda must receive it by before 30th November. No, can't, because when it comes by sea, right, that is a different contract carriage with the ship. It's, what is within his control? He can manufacture, he can do all the, he can get the inspection, he can do all that, give the quality, make quality goods, everything can do, right? But and ship it, hand it over to the captain. But can he be responsible? What is happening on the ship voyage? He cannot be responsible. It's something beyond his control. From Singapore to Sri Lanka, when coming at Colombo, what can happen to the ship? Ship can sink, ship can crash, ship can be pirated, like I told about pirates and all that, right? But is it the concern of the exporter? Is it within his control? It's not within his control. Once he hand over, that's it, done his job. So we told the importer, we can give a guarantee to the ship to the exporter, only saying to him to ship the goods before date. We can't give an LC saying that the goods should arrive before 30th November in Sri Lanka, because we don't. Once he has handed over the goods to the ship to the captain, he cannot be held responsible for what is happening in the voyage. Another ship comes, crashes, when sink, when be hijacked, when pirated, you can't. So therefore, that's not. So international trade, right? The undertaking given, when you issue an LC, you will only tell the exporter by when he should ship it. After that, what happens is not logical to hold him responsible, and he will not agree also. How can he agree to something he can have no control about? He says, no, I don't like the LC. How can I say? I give the captain, he's carrying the money. I'm not responsible. Right? Isn't it? You give a lorry, hand a gunny of vegetables from Dambula to Colombo, and middle of the lorry happen, what can not get the person, the lorry in Dambula do? Not his responsibility, right? You're taking the risk. If I'm taking Colombo, I am buying it. I am taking the risk of whatever happens to the ship, to the lorry from between there and from Dambula here. That basically. So therefore, we don't put normally. We never put that to reach Colombo, right? We always say ship before, date ship. So once he has shipped it before 30th November, that means he has complied and the bank will pay. Now, in this context, when the documents come here and the importer calls Mr. Banda and says, Mr. Banda, documents have come, we have to make a payment, right? Under the LC, you have no money in the account. We can't go back to the exporter and tell him, we means the People's Bank can't go back to the exporter and tell him, look here, my friend, our customer has no money in the account, right? So therefore we can't pay. No. Under document credit, he will say, look here, Mr. People's Bank, don't think I don't understand trade. I don't understand what a letter of credit is. Letter of credit, you told me to ship before the 30th of November, and you asked me for some documents. You asked me vacant list, you asked me wait list, you asked me origin, you asked me the inspection certificate from SDS. I gave that also. Okay, my commercial invoice, how much it payment is there? It's not beyond what you told me. You said 10,000, for 10,000 sent it. They're not gone beyond the bill. They're not gone beyond, not asking more than 10,000. You said 10,000, I paid your bill to 10,000. You said 25 items, I shipped 25 items, all according to what you said. I have done everything what you said. Now, since I done what you said, you have to pay me, because in a LC, right? In a LC agreement, LC undertaking, right? The agreement is between the importer, sorry, the importer's bank, the bank that is giving the undertaking, the issuing bank, which is the People's Bank, and the exporter. Only the contract is between these two. Okay. Nothing to do, exporter has got nothing to do with the importer. Under the LC agreement, importer does not play a part. Whatever the importer has is now when the importer's bank issues a document credit, or I'll call it LC, right? Electronic credit, LC to the exporter, right? The bank that is people issuing the electronic credit knows that I have given an undertaking to the exporter thing, and if he ships the goods, I have to make the payment. Okay, so therefore there is an exposure. Then the request to give the exposure is by the importer. That is a relationship between the importer and his bank. Whether People's Bank or whatever Sri Lankan bank is willing to give an exposure of, we say $10,000 to Ching, that you ship the goods, I'll pay, right? Depends between the relationship between the Mr. Banda and his bank. Sometimes you say, my God, Mr. Banda, if I give that data to the exporter, right, and then he ships the goods, and November, today is only 19th September, today you have 1 million account. What if 30th September comes and you don't have any money account? Then where do I catch you? How do I get the money from you? I can't say no to the exporter. He has performed under my LC, my undertaking, my contract between the exporter and me is there. So I have to honor it. Okay. So what do I do? Whatever 30 you don't have. Then you say, Mr. Manda, I'm very sorry, I'm not sure about you. What you can do is you deposit money to cover this $10,000 with me. Keep in the bank. Put a FD or whatever you have. Keep it with me. And then I'll give interest till the documents come, and then I'll apply the FD and pay the money. But keep the money 100%. I can't lose. Right? That may be one angle, the agreement between the importer and the bank. Another, maybe Banda is a very good corporate customer. Very good customer. He has other facilities as well. He will say, oh, Mr. Banda, don't worry. I will issue that guarantee. I don't need any security from you. You are a good customer of ours already, right? Or I know you are a very good customer in the market. You are a corporate client, well accepted in the society. We have no doubt that on 30th of November, you will definitely come and pay the money and take the documents. If you are having that sort of judgment against the Banda and company, then you will just give the undertaking without taking anything. No deposit, nothing. Right? Or you might say, $10,000, you don't have money? No, I don't have money now, he say. Then mortgage your house, like usual. And then, whether goods come or not, we don't care. You mortgage the house, you sell the house. Right? So that's not the attitude actually, right? So that way, so depends on what agreement the importer writes with you, with the issuing bank, as to how the LC has to be issued. However, whatever security you may take, whether you deposit 100%, the exposure under your issuance of an LC has to be reflected. There is exposure under him. Exposure is $10,000. Secured by a deposit, there is something else. That is only security. But this exposure has to be exposed, has to be accounted for. So maybe today it will be one LC, 10,000. Tomorrow another LC, 25,000. Another person has imported another LC, 30,000. So he may have to open about 4-5 LCs. You might have to carry an exposure. Then you have to give him an LC facility. Calculate the LC facility and then give him how much LCs he has to open. Give facility. Okay, LCD facility is 1 million rupees. Up to that, you can open any more LCs. You can open 100,000 with Singapore. You can open LC for 25,000 Hong Kong. You can open 30,000 with US or 40,000 with UK. Altogether, your total limit is 1 million. We will then you give that. Okay, that facility. So that will be LC facility, right? Now they have the credit side of it. Now coming back to this. Now here you see the security has not like collection. The moment he complies and ships the goods and the documents are sent like this through his bank to this bank, right? The bank has to pay. Can you see that? That's how LC works. Now that exposure that we had in collection, where he will not, importer will not accept the goods, is not there. Why that? Because they are working on an LC basis. He has shipped the goods, send the documents, he has sent the documents, right? Issuing bank, then documents come. Now here, whether the documents are given to the importer and he pays money, this part is not relevant to the exporter. Once it comes here, the importer's bank who issued the LC has to pay. Well and good. If it is the money is available in the account, the same day they will debit his account, take the money and send it, right? But if he has no money in the account, still the issuing bank can't delay the payment. They have to make the payment to the exporter, right? And then either give some facility, particularly till he can pay, or put it as past due bill or whatever. That part I don't know. The credit part you know. So this is what else is. So the main crux you understand is in a collection, whatever said and done, acceptance of the shipment by the importer is important if the exporter has to get the money. Whether DA, DP or DFLI, no point. If the exporter does not accept the goods, then if the importer does not accept the goods, then the exporter will lose the money. Can lose the money, right? But under LC, right, whether the importer has the money, whether the importer wants to take the goods, he doesn't want the shipment, he rejects the shipment, is immaterial, right? The importer's bank will have to pay. How we are going to recover from the importer? That is the arrangement between the importer and the issuing bank, the bank. So that is a different relationship between these two. In LC, the relationship is only between the issuing bank and the exporter. Right? Now do you get the crux of what is the document credit? Yes or no? I presume yes, huh? Okay. Right. Now, let me go to the next one. Now, in document credits, there are various types of document credits. Right? Various types of irrevocable document credits, right? Now, when you say irrevocable document credit, all letters of credit are irrevocable. Very rarely you get a revocable document credit. What does saying that please ship 10 red cars. Right? Please ship 10 red cars. Before November 30th, I'll pay you, we'll say $1 million, right? $100,000. We'll just say 10,000 car, right? For example. Right. So 10,000, 10 cars, 100,000. That is what the main part of the LC is. What this bank, right? Banda's bank has issued on behalf of him to the exporter. Ship 10,000 red cars before November 30th, right? November 30th. and then other documents, blah blah, technology, no, what is called. Once they have sent that message to him, right? Once they send that message to him, that and he has received it, that message is the original instruction by the issuing bank, Bandas Bank, right? That instruction cannot be, when you say irrevocable, right? Is that irrevocable means after giving that condition, whatever they are told, whatever the issuing bank has told the exporter, red car, right? 10 red cars, $100,000 before, not a single condition of what they are told can be changed after that. You can't tomorrow, 1 week later, go and say, yes, given time no, till November 30th. You can't go after 1 week, about 1 month and say, no man, I want you to change from 10 cars. I want you to send 10, 10 motorcycles, right? You can't change. Just example, one example. So whatever the issuing bank says is irrevocable, right? Whatever the issuing bank says is irrevocable. Understand? That means he cannot change. Once he has issued an LC, once he has issued an LC, once he has given the LC there, 10 red cars, shipment before November 30th, and whatever other conditions, nothing can be changed by the issuing bank. That stands. That is what you call irrevocable. Not you can not revoke it. You don't issue revocable LCs, right? Where it'll be a disadvantage, no? Now, for example, can you say LC can be revocable if the person can change? Now say November 30th is the shipment date. Now he has got a LC for 10 red cars. Okay. So what has he done? He has gone, he has set up a shed or something, a workshop, right? Got the people who knows to make cars. He went and bought all the metal required to make the body. He has bought the wheels for that size. He has bought the engines for the car. And now it is September 9. In October 19th, he's changing it, right? He's changing it and saying, okay, no, I'm changing this. Now we need some. Can you change that to 10 blue buses? Now change it to blue buses. Now in October 19th, if he goes and tells that, there can be at that moment in October 19th, he may have manufactured about 2 cars, right? Or 2 or 3 cars he may manufacture. November shipment, no. He may manufacture keeping ready for shipment. Another 3 cars may be partly done, right? Work in progress. Engine is fitted, wheels are fitted, other body and all made, all that done. And another 4 cars still to manufacture. Now, if he goes in October and tells the exporter, change it to buses, what do you think will happen to the exporter? What happens to all what he has made? Whatever the car he has done? What is the car that he works in progress? Whatever the metal he has bought for the, maybe metal is different for the buses in comparison to the cars? What happens? He's in trouble. So that is why you say that when an LC is issued by the importer on behalf of the importer's bank, it is irrevocable. No condition can be changed. Right? Cannot be changed. But however, say for example like this. So September 19th, we issued an LC saying 10 red cars, okay, 10,000 each, 100,000. At that moment, the exporter gets his family has some leave, and he goes abroad. He takes his family for holiday. He's going to Las Vegas somewhere, right? Enjoyable time. He got a good order in hand. He knows making money, so he goes and pays, does all the gambling, laughing, enjoy his time. And then he comes back. And then he comes back on the, say, end of September. He sees the bank has sent another note to him, right? Saying, look here, we sent you originally, we told you we want 10 red cars at $10,000, but now small problems occurred. Now the market demand is for buses. Can you change it to 10 buses? Of course, buses are big, but your car you said 10,000, but we are willing to pay 15,000 for a bus, right? Then the exporter might think, I say, now it's time, now the order is bigger also, money is coming in, $15,000 instead of 10,000, right? And I spent a lot of money in last year also. Since I not started manufacturing, what's the problem? I can change, no problem, right? If you want buses, I'll give buses. I not made any car, I not started even on the job. So I don't mind the change, right? Now, I told you irrevocable now. So here question is it irrevocable for the exporter also? Right? No. If the anything what the issuing bank issues is definitely irrevocable. However, if the exporter is agreeable for the change, then that condition can be changed. You see? Express consent of the beneficiary. So if the beneficiary consents, you can change. The exporter likes. Now you ask, what is this express consent of the issuing bank? Confirm what is this part coming. This part, leave it for the moment. Huh? Don't worry about it. If any, no, right, don't worry. And consent of the issuing bank and the beneficiary. First of all, the importer is going to tell the importer's bank, look here, you issued an LC for 5 cars, for 10 cars, green cars. Now I want 10 buses. I'm willing to pay 15,000. Please tell the exporter. So if the importer's bank thinks, shall I accommodate it? They'll say, oh, now see 15,000 exposure is going up. Then he's satisfied one time company. That part issue maker accepted. Once the issue maker accepted from the request of the importer, then he will inform the exporter, the beneficiary, right? But there again, still can't change only if the exporter is agreeable. If the exporter is agreeable, then he can change, right? If the no, it's okay, I'm not start my work, I can do. So an LC issued is irrevocable, but subject to changes only if the beneficiary is agreeable. So beneficiary or the exporter has to agree. Agree only you can change. Otherwise, if the exporter gets a after halfway manufacturing, he gets a request, he can just take it and put it in the basket. Hey, crazy guys, ask me to make buses now. Halfway I've done this. I got 2 in work in progress, I have 2 completed, 3 in work in progress, I bought the material. What is he asking for buses now? He just take a question and just throw it up, right? So if he doesn't consent, then you can't change. So that is what we call what LC issued by irrevocable, subject to only change. The change of a LC, continuous LC is known as an amendment, right? When you change LC, you call your amending LC. You don't say change, you say amending, right? So I'm not going to much detail. I told you I'm going on the servers. Okay. All right. Now comes, that is what we call irrevocable LC. Now comes the irrevocable confirmed credit. What is this? Now, don't worry, these are all simple, small things, right? These are not really big issues. When you say irrevocable confirmed credit, now we'll say this part is, we'll assume that this part is Sri Lanka, right? And this part is, say, Singapore. Okay. Or we say Singapore knows no much about Sri Lanka. We say, just say UK. Far away place, right? UK. Right. Okay. So now the Mr. Banda has spoken to him. They have issued a LC to a exporter in UK. We say Smith and Company, Mr. Smith. Right. Mr. Smith. Now Smith has got a LC from, say, I won't mention the bank, just the name of the bank in Sri Lanka, ABC Bank. I hope there's no bank called ABC in Sri Lanka. ABC Bank, Sri Lanka. Now Smith says, ABC Bank has given me an issued an LC to me. So ship, say for it 10 cars, right? For 100,000. But then for the ABC Bank, I don't know who the ABC Bank, but Sri Lanka, Sri Lanka. How is Sri Lanka situation? Is the economic situation okay there? Are the risk they don't what are the factor risk we discussed? Bank risk, country risk. Can you remember? Yeah, and that he's thinking. Who is expert is thinking? Country risk. Sri Lanka economy. What is happening? Is it stable? This guy says, I only know to manufacture cars, but I don't know much about whether the risk is Sri Lanka risk is okay. I have a doubt. I'm not sure. I can't say yes or no, but I'm not very sure. Then ABC Bank. What is this bank? Is it a good bank? He says, no, I am very scared. Even though the ABC Bank Sri Lanka has given an undertaking to pay him, he is not happy. Right? He is not happy. So, in the payment method, document they agreed on these two. What they have agreed is, yes, documented credit, agreed. Expressed Mr. Smith says yes. But even though it's a documented credit, I want this documented credit to be a confirmed documented credit. What does that mean? That is what I'm trying to tell you now. When you say confirmed documented credit, what it means is that he'll say, I don't know about good bill documentation, the fourth method, no, but I want it, documented credit is a method, but I want a confirmed documented credit. What it means is, he's saying, tell your bank, they will have their friends agreements with our country, UK, right? Tell your bank to issue the LC, but also make arrangements for my bank. My bank is Standard Chartered, UK, right? Standard London, what do you say? London, to confirm your LC. The LC that your bank is issuing, confirm it, get it confirmed. The LC that your bank is issuing, get it confirmed by our bank in London. So then what happens is, this bank, right? This bank will say, we'll say Standard Chartered London and ABC Bank Sri Lanka have an understanding, right? They have understanding. They will say, look here, man, your customer is Mr. Smith. I wanted to issue an LC to him direct, right? Without undertaking, he is not happy. He has told our Mr. Banda that he okay for irrevocable credit, but he wants it confirmed by you, Standard Chartered London. Can you please advise him this LC that we have issued one, and that you are confirming it. So then Standard Chartered calls Mr. Smith. Mr. Smith, you're getting LC from ABC Bank Sri Lanka. Mr. Smith says, yes, Mr. Tom, manager, I am getting LC from Sri Lanka ABC Bank. I don't know much about the economy, how stable Sri Lanka is. I don't know. I hear news here and there. Then also the ABC Bank, Mr. Tom, I don't know anything. So I told him, I will accept an LC from ABC Bank, but I want you to confirm it. So what is happening is, when you say confirm, the Exporters Bank, Standard Chartered Bank, London is now can you see the guarantee of payment? Guarantee of payment is saying, Mr. Smith, you don't worry. Sri Lanka economy, no problem. Don't worry. That operations are okay. There's no issue there. But we have long-term relationship with them, and we know the economic situation. You don't have to worry. Also, ABC Bank, long-standing relationship we have, they will honor their claim. Don't worry. But since you are in doubt, right, you accept the undertaking of ABC Bank, Sri Lanka, no problem. But in case you are having a doubt, if ever, which will never happen, he says, doesn't matter, we are giving the assurance that if ABC Bank, due to any reason, for example, failure of the bank or failure of the country, is unable to pay you, then we as Standard Chartered Bank in London are guaranteeing you payment, right? So now the exporter is having two assurances. One is he is having the assurance of ABC Bank Sri Lanka under the LC. Okay. Additionally, he is also having an assurance from his bank London saying that if the assurance given by ABC Bank Sri Lanka is not honored under any circumstances, we guarantee you the payment. Okay. So that means the Standard Chartered Bank is adding confirmation to the LC. That is what you get in this. See, irrevocable confirmed documentary, that's the meaning. You can see here. Yeah, see. So what happens is, the exporter in London is getting a double assurance of payment. Can you see? Getting a double assurance of payment. So that is as far as when a customer, sometimes when the exporter, they only know the export products, no, they don't know about countries, they don't know about banks. So when they have it out, they are comfortable when their own country, somebody guarantee the payment. So then they tell the importer, please get a confirmed irrevocable credit. That we get. Now Saudi Arabia also, when I was working, their Sabik is a prime exporter of petrol product. They will never accept whatever, even as Golden Bank, World Bank, they will not accept. They want one of their banks to guarantee, confirm. All the LC to guarantee, irrespective of what bank issues the LC. US or whichever country, they don't care, they want it confirmed, right? That's the policy. So like that, that's why confirmed. Now then we come to the next one. What is the next thing we have? Revolving document. Right? So I will what I will do is, I will stop here now for a break, and then we start on revolving document credits. These you don't have to know much in detail. I will cover only little detail you might come into is what is a transferable document credit and a back-to-back letter credit. Okay. In this I might have details, but other than that, I'll finish this, and then we can go on to some trade loans and all that about trade, then Incoterms, and then we can call it up. So now we'll have a break. Say now it is 10:25, say 10:40. We can come back. Okay, guys? Alright. Now I told you about, spoke about confirmed document credit. Like where you say the customer, he wants a document credit. Not only that, he also wants a confirmed document credit, right? So now, like I said, okay, we took this as UK. In addition to the ABC Bank of Sri Lanka giving him a guarantee, right? He wants a guarantee from UK. So Standard Chartered Bank London is also giving him a guarantee. So he has two assurances. two guarantees. If this fails, he has this support. That is what you call a confirmed irrevocable document on credit. So if the bank, another bank adds confirmation, okay, right? Can you remember irrevocable is conditions cannot be changed without the consent of the beneficiary. Then we saw a thing called a confirming bank. So if that particular LC is confirmed by a bank, then changes, amendments to that LC, irrevocable LC can be done with the consent of the beneficiary plus the confirming bank. Not only the exporter. Because if you change without telling the confirming bank and say there's some amendment they want to do and beneficiary agreeable, but confirming bank will say no. If you are changing this condition, then of course I can't give my guarantee. For example, I'll give you like example, say they are changing the shipment was November 30th, 21. Now the importer says no, we will make it November 30th, 22, 1 year extended. But the confirming bank, now what will happen to the confirming bank? They are giving a guarantee, no. So they also have to extend their guarantee, no, if that is the case, up to 30th November 22. So sometimes the confirming bank may not be willing to carry the exposure for that long. So they'll say, no, this amendment is not agreeable. You can do the amendment, then our guarantee is withdrawn. Right? So therefore, any amendment, if a confirming bank is involved, then for any amendment, not only the beneficiary's consent, the consent of the confirming bank is also important. Right? We finished that. Let us go to the next one. This is because I'll go quite briefly. Like I told you, revolving document credit, red clause document credit, standby document credit. These I can go quite quickly. I can finish it. These two I may have to take a little time. Okay, we'll see what we can do. We'll manage. Don't worry. What happens is, what we mean by the irrevocable is, when you read this paragraph or whatever, read this slide, you will be easily able to understand. So don't worry about it. Now after explain, you will exactly know where to read, right? Okay, now we go to this. What happens LC? Importer opens an LC, then that LC is sent through his bank, okay, and then his bank to the exporter, to the exporter's bank to the exporter. All right. Actually, why the involvement of this bank is known as the advising bank is because supposing a LC is received by mail straight to him in London, Mr. Smith in London, he won't know whether this LC is authentic or whether really coming from ABC Sri Lanka. How will he know? Just the postman came, gave a letter. That's all. A registered letter maybe. But how do you know whether this undertaking is really authentic? Whether ABC Bank really issued this? Normally we do advising by SWIFT. So what the role of as an advising bank here is, the Standard Chartered will, once they receive, they have an agreement with these two banks. Once the Standard Chartered Bank receives this LC from ABC Sri Lanka, it will advise the LC to the exporter, Mr. Smith and company, saying that we confirm that this LC has come from ABC. It's an authentic message. So you can go ahead and act on it. It's an authentic message from ABC Bank. So what this bank does is it confirms the authenticity of the message that was received from ABC Bank. Otherwise, Smith will not know whether somebody has forged and sent the message or whether real message. You can't know. Type and send a message. No. So once the exporter gets the authentic message only, he will do the shipment. So authenticity of the message is confirmed by the advising bank. Normally, his bank will say Standard Chartered London, right? So otherwise, It's dangerous for Smith to operate on LC which does know whether it is authentic or not. So authenticity of the guarantee issued by or the LC issued by ABC Bank Sri Lanka is done by this bank. That's why called advising bank, right? Then there's another called negotiation. What is this, right? This sort of what I'll explain this to you. Very small item in brief. Now we'll say this LC is a usance LC. Usance means like a DLC, call it DA or usance means your period. Now the exporter has given a LC to the importer. The terms are the issuing bank has said, please ship some goods to our customer Banda, and we guarantee you that after 90 days from the date you ship, he will make the payment. We will make the payment. Basically, he pay, we will pay. So now the issuing bank is not going to pay immediately. That's what you call site LC. That's what you call a site LC. But this is a usance. Usance means the exporter is willing to give a certain amount of period of credit, right? So the LC opened by the issuing bank is known as a usance LC. Say 90 days, what will assume 90 days. So after 90 days, from the date they ship, say 30th September, 30th October, 30th November, 30th December, the issuing bank is guaranteed payment to pay after 30 days, after 90 days to pay the money. But then what happens is, now he has shipped the goods and come and give the documents. Now 30th September shipment. Now when will he get the money? 30th December, right? I'm making this very brief, I'm not going into very much detail, just for you to understand what it is. So now, if that is the case, he has to wait till 30th December to get the money from this bank. But in the meantime, he has other shipments to do. Right? So what does he do? What he does is, now $100,000 is the shipment is, he comes and says, look here, you send these documents to ABC Bank Sri Lanka, they will pay on 30th December. But in the meantime, I can't wait because I got other shipments to do. Can you give me the money against those documents? Against the payment I am going to receive from ABC on December 30th, please give me the money. So what the Standard Chartered Bank, first he advises LC, he does the shipment, bought the documents, not bought the documents. So what the bank does is, what the SCB does is, pending receipt of money from ABC Bank on December 30th, when they say he submit the documents, say he submit on the somewhere on the 5th of October, right? He did the shipment before September 30th. He did the shipment and gave the document on the 5th of October, right? On 5th of October, because he's asking for the money, Standard Chartered London will advance. Pending the money to be received on December 30th, the Standard Chartered London gives you the money in advance, right? That is called negotiating bank. What is called? Don't worry about it. That is basically the meaning of this is this bank will pay before getting the money from the issuing bank. That is what I'm saying. For the convenience of the exporter, because he has to do some other exports, right? Sometimes even if it is site LC, immediately document it has to pay, but still it takes about 10 days to go checking all that period. UCB 5 working days, all that it takes about 10 days. So sometimes they need the money. Before the money comes in 10 days, the bank can make the payment on a 10-day basis, discount basis. Discount 10 days, right? That way. So when the not that it's bound to do it, but it earns money, it earns interest, it will make a profit out of it by discounting. So Standard Chartered London, if it discounts LC and pays it before getting the money from them, then they do the negotiating part like a negotiating bank. That's enough for you to understand. Negotiating bank means the bank pays before getting the money from the issuing bank, right? That is what we call negotiating bank. So right now coming back to revolving LCs. So what happens here? Here he opens an LC, then he goes, then LC goes there, he goes there, then he ships the goods. Then documents come, he gets the payment. The next shipment, what is he opens another LC, it goes to that, goes to that, goes to advice, all that again. Another shipment he wants, goes there. Now what happens is you find that it's very cumbersome for the importer to keep on opening LC every shipment. So what he does is he opens one LC, right? Okay, he opens one LC. Say his shipment requirement is he was at any one time a shipment of $15,000 worth of shipment will require. Say he's a manufacturer. He's a manufacturer. He's a manufacturer, right? So he requires materials, $15,000 worth of material at any one time. But instead of opening LCs at 15,000 every time, what he does is he goes and opens an LC. Here's the bank. Open an LC for 90,000. 15 into 6. 6 shipments. 6 shipments, right? And that is 90,000. Now the LC that will open will be when he gets the LC, he'll read this LC is value, total value is 90,000, right? And this is a revolving LC of $15,000 a shipment, right? So he's saying when you say revolving $15,000 a shipment, that means if the LC is $90,000, the exporter can't ship all $90,000 at once. So it is saying revolving by $15,000 a shipment, right? So it says $15,000 a shipment. So the exporter can ship 6 shipments, 15 into 6, right? 6 shipments of $15,000 up to a maximum of $90,000. That is what we call revolving. So he doesn't have to open 6 LCs every month. 6 LCs doesn't, whatever. Now we'll say his requirement is opening, he wants $15,000 per month, right? Otherwise, what will I do? Every month he will open LC. So what he says, no, this LC is revolving at 15,000 rupees per shipment, or sorry, $15,000 per shipment. But this LC, you have to do the shipment every month. If you say he opened the LC in February, then March, April, May, June, July, August, up to August, every month he can do the shipment. 15 into 6. February, see, open February, February open the LC. So between 1st February open the LC. So between February and 20th February, you can do one shipment. Then March, April, May, June, July, August, right? That's what it means. That is, he's giving a time. The time is every month, right? Then you call that LC is revolving. That LC revolves by time. It's a LC revolving by time. That you call that is a revolving LC for $90,000 revolving by time. They given a time, month, right? It can also say, no, you can ship $15,000 per shipment. Yes, that's the revolving. But I'm not giving you time like month, right? It can be by value. So if you open the LC on February 1st and you say revolving 15,000 by value, what it means is he can ship 15,000 on the 5th of February, and we'll say the total period given for him is up to August. Is valid till August, you say. So he can ship 15,000 on 5th of February, 15,000 on the 20th of February, then he can ship another 15,000 in June, March, April, May, no need. And again, June, another 2 shipments. Like that, he can spread the 6 shipments up to August by value. The moment he just 15, he can do another 15. He can even do 5th, 6th, 7th, 8th, 9th, 10th, done February, one ship, that is also correct. It is only the revolving done by value. You do a shipment of 15,000, you can do another shipment. There is no time given. Actually, what happens is they open this like this, and the importer cannot judge when his raw material will finish, because if the demand is high, his raw material will finish fast, right? If demand is low, he might have enough raw material. So what he agrees with the buyers, he says, here I am opening a revolving LC to you. by value. I don't want to say monthly because I cannot say whether I need every month. So I'll open it by revolving by value. I will send you a small note. I'll give you a call. Okay, send me 15. February 15 now. Big order came, finished. By February 20th, finished. Send me again. Then March, April, all holiday period, no shipments. Nobody will do buy things. No people to work. Don't. So the exporter and the import coordinates with the exporter and tells him when to ship. That is by value. Up to August, exporter will accommodate the import request that when he tells to send, he will send. Right? So that is by value. As and when the import requires, he gives a call and he sends it. But spread over a month of 6 periods and 6 shipments. Right? That is revolving by value. Right? Okay. So you know what is revolving by time. Time basically this every month or every 1.5 months or every 2 months, whatever. Okay. Then that is that way. Then there's a thing called the revolving LC is cumulative or non-cumulative. That's another thing. What is cumulative? What is non-cumulative? For example, you say you open the LC revolving and said this is revolving for 6 months from September. From we said February, March, first shipment in February, next in March, April, May, June, July, August. June, July, maybe end of July, right? We'll say 6 months. February, March, April, May, June, July, 6 months gone. Right. Now every month he can do 15,000. If he does a shipment on 10th of February, 15,000, the next shipment he can do between 1st and 31st of March. If he does one shipment that, then he can do between 1st of April and 30th of April. Like that. Okay. That's it. Now, he did the February shipment, he did the March shipment, but April holidays, he took his children and went overseas. Right? He went for a holiday somewhere. We'll say he went to Hong Kong or somewhere, or Europe or something, European tour or something. Now he comes back in May. Now the question is, since he missed a shipment in April, can he do the shipment? April is 15,000 plus his missed shipment is in April. He could do May 15,000 plus missed shipment of April 15,000. Can he do a shipment of 30,000 in May? Right? Whether that is allowed in that LC. In that LC, it will say this LC is cumulative. Right? When you say cumulative, that means if you miss the shipment, like April shipment, you can cumulate it and add it to the next shipment. Okay. If you miss the May shipment, you can add the April May shipment and ship it in June. That is what you call cumulative. Right? But if the LC says non-cumulative, right? If it is non-cumulative, then what it means is that if he has done a shipment, not done a shipment in April, then in May, he can't add it. He has lost the shipment. He can only do the May, June, July, that's all. So what he missed in April, he cannot add. That is known as non-cumulative. Understand? That is what you call non-cumulative. Well, now what is the advantage of this? What is the advantage of this revolving LC? One thing is, it's easy for the importer, right? He doesn't have to type LC, fill the application form every month, get it signed by the signatories, authorization of the company, chairman. He may be out. April open LC is there. May he may be out of the company, gone overseas. Then difficult to get a signature, all that, right? So that then you have to find logistics to bring the LC card to the bank. Then whatever electronic system, some authorization, all that. So it is a cumbersome thing, right? Okay. And also every month the importer has to pay LC commission for opening LC commission. So the importer might say, look here, my friend, I am opening LC for 15,000, you are charging me, right, 0.25 commission for my LC. So see, now I'm going to open for 90,000, 6 LC like at once, right? You're not going to work for, you're not going to type 6 LCs, no. You're typing only 1 LC, right? But 6 shipments. So you are charging me 0.25, why don't you give a small discount? Importer tells his banker. So importer banker saying, yes, we don't have work, no, we're not typing 6 LCs, no, right? Only 1 LC. Okay, we will give something, we'll make it 0.2. So opening revolving LC, the importer has a sort of a, he has a discount on his cost. Second one, he has program his imports. He knows I have booked the shipments for this amount, so I'll get the shipments. He can go and plan his production and all that. Every month shipment will come, right? Because you know why? Now he does open shipment in April LC, then he does not show whether the supply will have shipment goods in May, because once he gets the LC, only the supply will go to the export will go to find the goods for him. So then he's not sure, though he opens it, he's not sure. But in this case, right, in this case, what he does is, once the exporter gets a revolving LC for $90,000, what the exporter will do is, he will go to raw material supply and say, sir, I want to buy some raw material. What is your cost? What is the price? $2, we'll say just example, $5 a meter. Some raw materials here in length, right? 5 meters, $5 meter. How many you want? No, I want to buy for $15. He says, look here, my. Then now the export tells him, look here, I am not my each shipment I buy from you $15,000. You gave me $5, but look here, I got a revolving LC, $90,000. If you give me a good rate, I am going to buy $90,000 worth of raw material over a period, right? So then the man supplier say, oh yes, the bigger sale. He got a revolving LC, $90,000. So he is booking the material for 6 months. I think I should give a discount. Understand? So he books the supply for 6 months. So 6 months of supply is booked, right? Then the importer knows that the exporter has booked the 6 months supply. He'll get the 6 months supply. Also, the exporter will bargain saying that now look, it's not like a single LC, it's a revolving LC. So therefore, I'm going to take 6 shipments from you for $90,000. Get me a better rate. He said, oh yes, right. Okay, I'll give you 425. Okay, 425 for 450, right? Now the exporter, his normal was $5, no, right? So now it is 450, and the amount that the exporter, the exporter quoting to the importer was $6. He was making $1, right? But now because he told the supplier, I'm going to buy for 6 months, he has made it 450, right? Okay. So what the exporter can do is, he can tell the importer, look here, my friend, you're a good friend of mine, you give me a good order now. I normally told you $6. I'll make it $5.75 for you, a meter. Still, he made $50, 50 cents on a dollar. He gives 25 and gives 25 cents to the importer. So importer gets a low rate, and the exporter gets a good rate from the supply. He got 50 cents less, right, per meter, from $5 to $450 now, and he was selling for $6. So $1. So now that means totally $150 making now. $50, 50 cents here, $1 in profit, $150. What he does is, he gives 25%, 25 cents of that to the importer, and tells the importer, I am reducing my rate to $5.75. Why? He's getting $450 now. So he gives 25 cents and gives the importer 25 cents. That way advantage for the importer. Then he'll go to the shipping line and tell, my dear friend, I want to do a shipment from say UK to Sri Lanka. What it cost? Oh my God, freight charges. We have to charge you at least $5,000, right, for a shipment. That is saying, well, one trip, no, I charge $5,000. Now look here, I got a revolving LC. 6 shipments I'm going to do. I will be coming to you for 6 times. I'm guaranteed, you see. revolving LC. Then he, so shipment, oh my God, then I'm going to go to business. So the shipping agent might say, okay, how much I tell you? Freight charges, $5,000. Okay, I'll make it $4,000. Right? Understand? So then the exporter gets a discount on the freight also. So he can maybe give part of it to the importer. So exporter gets a better rate because of the bulk shipment. Then he goes to insurance and he says, look at insurance, I need to cover insurance for shipment from UK to Colombo, London to Colombo. What is your charge? Normally you're charging me for one shipment 15,000, you're charging me a premium of $500, right? Your premium $500. But see, I got revolving LC, 6 shipments. Insurance, my God, the guy is going to give me six insurance is going to take now. Okay, I'll make it $400 for you. So he gains $100. So that was he might give part of it to the importer, right? So therefore, in the revolving LC, importers can gain, exporters can gain. So it's convenient to the importer. Maybe gets a better price from the exporter. Exporters are happy because he can make bargain with the shipping agent, with the supplier, with the insurance company. Maybe he can go down and down further. Inspection company, he can get a good discount for the inspection when 6 shipments are going to be inspected. So like that. So then that is the advantage of a revolving LC. Now let's stop that revolving from there and go next one, rent clause. This is a very simple LC. Now I told you about revolving LC, right? Cumulated, accumulated, cumulative, non-cumulative, time value, time, revolving by time, revolving by value, all that you know. There's nothing called revolving LC, automatic, non-automatic, but that I think you don't have to know much about it, right? It's not that relevant, okay? Then come to irrevocable. We finish this one. Then we got rent clause. These are very simple, straightforward item. What you get in this is now there is a take Sri Lanka example. There is a handicraft exporter in New Orleans. Not exporter actually, a man who manufactures handicrafts in New Orleans. So let us say that some Middle East guy from, let's say, the country wherever, Saudi, he comes. He goes to New Orleans, goes to Grand Hotel, stays there, enjoys, and then he goes around New Orleans. And he comes and sees this handicraft company and says, wow, this handicraft is very nice. Very nice. I want to buy this, right? And he says, I will go and give you an order. Every month I will buy from you $100,000 worth of handicrafts. I know I can sell this very high in Saudi. A lot of people like this, they put their houses, right? I'll give you order for $100,000 every month. You send me the shipments and I'll pay you. Now the handicraft guy says, how are we doing? Collections, advance payment? No, he says, I can't pay advance payment to you, but I'm open handicraft manager, open account. Saudi, I said it there, you take it, you don't pay me, then I'm in trouble, right? Now how? We'll do document collection? No. Document collection, no, basic. You goods go there and you don't take it. What do I do with the handicrafts in Saudi Arabia? How do I don't know Arabic also to sell that there, right? So without knowing Arabic, I can't sell anything, right? Then I'm going to lose. No, I can't. Okay, LCs. Right. Okay, we do on LCs. Agree. But then the handicraft man says, one problem I have is that you see, I have money only now. If I am going to do this, you will pay me only after I do your LC will say, ship the goods and we'll pay you. Your bank is a good bank, HSBC is Saudi Arabia. I know it's good bank, you guarantee. But the problem I have is, right, I have to pack all these Now see, I'm manufacturing here, just people come and buy from me. But for you, I have to find packing, good packing. That is going to cost me. Then I have to find good trucks, right? And take the trucks from all the way from Norelia right up to the Colombo port and do the shipment. I have to pay for the lorry transport. When I go to Colombo, I have to find people to unload the things and load in the ship, then that's another cost. So I cannot afford to do all that cost. I can't that much. I can't do. The LC is good, I know, but I can't do LC because for to do that I had to do the shipment no first. For that I must have pack your goods, I must take it and transport. Oh, I don't have money for those things. The money I make, takas I make another production, other place, so I don't have money for that. I said, okay, right, no problem, no worry about, don't cry. And what he does is, the Saudi guy, he goes and opens a red cross letter of credit. It is a normal letter of credit, like what I just now discussed, right? It's normal. But in this one, the Saudi guy says, how much will it cost you? Packing, transport, going to Colombo, stopping on the way, having a tea and all that cost you there, no? Right. I will do something with it. He goes and opens an LC, normally ship $100,000 worth of handicars, payment comes. However, there is a small special clause which says, it tells the, let's say tells the bank in Sri Lanka, no, the opening forms, HSBC, Saudi opening in Sri Lanka, no, right? Says bank is Bank of no real or something like that, right? Says this LC, there is a special clause which says when you get this LC and when the exporter comes and gives the LC to your bank, right? You give him 10% of the total cost. Say $100,000 is LC, give him 10%. That is $10,000. Without making, before shipment, without doing anything, just give him against that LC, pay him $10,000. And tells the bank, you claim it from us. You want claim from us? Or what you do, you can, anyway, we'll pay you, don't worry. If he takes $10,000 and goes off and not pay you, I will pay you. That doesn't matter. The bank says. And take a letter from him, from the exporter, that he's taking this $10,000 to facilitate making the full shipment of $100,000 to Saudi Arabia under the HSBC LC. He will go to make use of 10,000 to make the shipment of $100,000 under the HSBC LC, which will use for packing and transport and all that. Right. So takes a letter on to take it from the exporter, and banks will not pay the $10,000 to the exporter. Right. And maybe it will claim from HSBC or it may not claim. That depends. Then what the exporter does is, now he got the $10,000 now. That is enough for him to make the packing, get it to Colombo, ship it. After shipping, he'll bring the BL, give it to Bank of Ceylon, and claim invoice, you say, total shipment $100,000, obtain $10,000 as advance, less amount claimed, net amount claimed is $90,000. And he will claim $90,000. We already got $10,000. Right? So here's a situation in an LC where the exporter is getting a small advance to facilitate the shipment. Right? Not all importers will allow this. But now maybe he knew, he came to Orele, he saw this guy, he saw his factory for a genuine guy, right? Nothing much to take a risk. His goods are very good, have good marketing in Saudi Arabia. So he was willing to pay 10,000 at 10% advance. Right? So he does. Now those days, in our time, we all are not born, right? When I joined the bank, our type is, they use typewriters. Right? So there they put ribbon, right? And the ribbon has two colors. One is black, one is red. Not like nowadays, you can put multicolors. Right? If this red cloth credit was started now, it might be named as multicolored cloths, right? But these are started those days now, right? So, since these are special instruction, which you don't normally find in LCs, this is a special concession the importer is willing to give through his bank, of course. The bank on the HSBC is giving the is issuing the LC. With his agreement, the importer has this bank. That clause in the LC was typed in red. You get typewriter. You get red, black, put it down is black. You put it up is red. And you remember, I know you all do not remember name. So only two colors, black and red. So these special type of LCs, when they are going to issue, where you're going to give an advance to the customer, it was typed in red, right? So that is how it got its name as red clause credit, red clause document credit, red clause LC. That's right. So basically, what red clause LC? The exporter gets an advance prior to doing the shipment to facilitate packing and other related costs in sending the consignment of goods under the LC. That is what it means. It's simple as that. Right? So I finished letter of red clause letter of credit. Then now we come down to standby. This is because I think most of you all know what it is. Standby with the LC or whatever is like a guarantee. I can quote an example to you. What is the standby? Can you remember under open account? What happens? The opener, the exporter sends the goods to the importer. Importer gets the goods and then makes the payment to the exporter. But the risk is, once the exporter sends the goods, importer may not make the payment. Right? Understand? So then what they do is, since the exporter says, tells the importer, you are insisting on open account, no? Right? I know I have dealt with you for a long time. I have a little trust in you, but I can't totally trust you. I cannot totally trust you. So what we will do is, we will work like this. I will ship the goods to you. You must make the payment. Then I ship again. Then you make the payment. But before that, you must get me a guarantee from your bank. Say if I'm going to say $10,000 a month, up to about say 6 shipments, $60,000 for example, right? You get me a guarantee from a bank saying that telling the exporter, now the importer bank is telling the exporter, right? You continue to go on open account basis with my customer. You continue sending goods and he will make the payment to you. But if he doesn't make the payment and you feel that you're not payment as a, say once in 2 months you have to pay. If he doesn't make the payment, then you are welcome to claim under this guarantee. So the importer's bank is giving the exporter guarantee. Go ahead and do open account with my customer, exporter, Mr. Exporter. You go and do ahead, go and open account with my customer, importer, right? But I'm giving a guarantee that if he doesn't make the payment on the due date, right, then you have the right to claim from me under the guarantee. So now the exporter is assured payment. He has a it's like a, he sends the goods to the importer, importer pays. Well and good, no problem, right? It's like a normal rugger match. 15 people go and play the match. Nobody gets injured. Match is over. Won or lost, they come back. So no problem, right? But if you're playing a match and one player gets injured, then what happens? The injured player comes out and the standby goes in. There are about 3 people who stand by. They keep on warming themselves. In Raghavan, you've seen they're just running up and running to keep me warm. The moment somebody injured, they go in. Similarly to that only, this standby LC also. Exporter sends the goods, importer pays the money, no problem. It continues like that. One shipment is sent, 10,000, due date came, no payment. It's okay. And it keeps okay 10,000. He says another shipment, that is not paid. Another shipment, not paid. Now the limit of the LC is $60,000. So even if it at $30,000, the exporter knows this guy is not paying. What he does, he has got that standby LC from the bank. He'll claim. He'll say, I sent 3 shipments so far and all 3 are not yet paid. 10, 10, 10, $30,000. Please pay me $30,000. Then importer bank has to pay. Right? That is what you call standby. Standing by. Like a support for the exporter. In case importer doesn't pay, he can claim again. In case a player gets injured, standby goes in place. Like that. That was standby. Right? Now, I hope I'm not going to make it confuse you much on this. Like one more statement I want to make. That is, in a normal LC, what is the exporter saying? Exporter is saying, here I have done my job. I have performed. I have shipped the goods. Shipping the goods is a performance, right? I have performed my good job and evidence is the BL. I have performed. So in a normal LC, the exporter gets money because performance has taken place. He has performed. He has performed, right? That is in a normal LC. Right? Now get this point clear. He performed, he did the shipment, so performance has taken place. In the standby LC, is the exporter saying that I shipped the goods, I have performed? Is that how he's asking the money? No. He's not saying I performed. Right? He's only telling the bank the importer who has to pay me has not paid me 3 shipments. His job, his obligation is to pay me after every shipment within 2 months. He has to make me the payment. Now 3 shipments has gone. He has not paid. So who has to perform? The importer has to perform the job of making the payment to the exporter every 2 months. Right? So now, how does the exporter claim under the standby? What is he saying? I have shipped? No. If he has said I shipped, then it's a normal LC. He is saying to the bank, look here, your customer is supposed to perform the job of making payment to my shipments every 2 months. That is his performance. The performance required under this standby, that understanding is that exporter has to perform. Now, importer has to perform. Right? Now the exporter is saying he has not performed. So how is the exporter getting the money under the LC? By telling that the importer has not performed. Then only gets the money. If he says importer has paid the money to me, he has performed, give me the money, they'll ask why you ask money again. Right? That can't be, If the importer has paid you 2 months, every 2 months, why you come and ask money again? Why you don't duplicate? So if the exporter says importer has performed, he doesn't get the money. But if he says the importer has not performed his duty of paying me every 2 months, then only you can pay. Then the exporter can pay. So the saying goes that the understanding is normal LC is obligation of the bank is against performance. Okay, ship the goods, have performed, you have to pay. And in a standby LC, right, obligation of the bank is to pay when evidence is given that of non-performance. Okay, important, not wrong. So normal LC is performance. Standby LC is non-performance. That is a major difference between normal LC and a standard LC. One, the exporter gets money again saying that he has performed. Another one, he gets the money standby by saying that the importer has not performed. Not that he has performed. You have to say importer has not performed. You see? So performance and non-performance. That is what we call standby letter of credit. Now, my friends, we are coming to a very popular topic, right? Which is known as a transferable LC. I done on a graph, you can understand, right? This is on a chart like this, it's easy to understand. What basically happens here is, say there is a buyer in Maldives, right? A buyer in Maldives. I'm going very slow because since it's going on the Zoom, I can't see you all how your expression is. I trust you all understanding clearly, right? So I'm going very slow, and I'm sure anyone can understand, right? There is a buyer in Maldives, right? Then there is another person in Sri Lanka, and there is a person in Singapore. 3 people, one in Maldives, one in Sri Lanka, one in Singapore. That is understood, no? That is very simple. Now this Sri Lankan guy, right? You see, Banda himself, he is going to Maldives and meets a guy in Maldives. Okay, we'll say he meets a guy called Nizam, right? Or shall we call it Ali? Easy words, huh? Meets a guy called Ali. So Ali is telling the Sri Lankan guy, look here, my friend, I want to buy 10 air conditioners, good ones, very good ones, right? But I don't know from where to get this down. Then that part you understood, no? Ali is asking about 10 air conditioners, good ones. Then he wants to know where to get it. I don't explain that also, right? Then our friend from Sri Lanka, Mr. Banda, he is saying, oh, don't worry. I will get you top class ACs, high quality, 2 years guarantee. Right? Right. Plus, do you have a do you manufacture? Sri Lanka guy says, no. I don't have any factory in Sri Lanka. I don't manufacture any ACs in Sri Lanka. But I do supply ACs through a friend of mine. I supplied to many people, not only Maldives, all other countries I supplied. Even in Sri Lanka I supplied, right? I have a very super company, most trustworthy, quality people in Singapore. He's the owner. Yeah, he's my friend. Right. So he says his name is Ching. Right. So it doesn't matter because now from Ali to find out who Ching is in Singapore, every other person is Ching there, right? Like we have Fernandez and Pereira, they also have a lot of Chings. So which Ching he won't find, right? So he says Ching. But he says, only problem is my friend Ching, okay, he does not deal on advance payment. Sorry, open account. He will not advance payment. No way, he'll never advance payment. He will definitely like to do it, but I also don't recommend. I can't do it with that. Then open account, no, he will not agree. Collection, he doesn't agree. He only wants LCs. He'll only deal in LCs, right? Because he gets a bank assurance. Bank assuring him, he's happy. Right. So he's telling Mr. Ali, Ali, we'll do like this. You open an LC to me. My bank is, we'll say, People's Bank Sri Lanka. And we'll say that is Bank of Maldives, something like, right? In Maldives. Okay. Right? Bank of Maldives. Or say Bank of Ceylon, your branch there, will take our branch you. Right? You tell Bank of Ceylon, your bank, to open an LC to me through my bank, People's Bank. But even though you open the LC to me, I cannot supply you. I can't ship the goods to you from Sri Lanka. I don't have factory there. Right? I can't supply you. I told you my friend from Ching. So he can supply to you only from Singapore. Right? So if I have to get you, and he wants LC, so if I have to get him to supply you, then I have to give him a LC. I have to transfer your LC you're sending to me to him. Fitting. Right? Then only he can ship. So he wants LC. I have to transfer your LC to Ching. Right? Then only he can do it. So what I'm asking you is, you open an LC to me in my name. I am the beneficiary. I am the right. Applicant is Ali. Beneficiary is Banda. Right? And tell in that LC specifically, very clearly you must tell. No mixing of words. That the LC you are opening to me, who is saying, Banda is saying, he's saying Ali, the LC you're going to open through me, through Bank of Ceylon, Maldives, must be a transferable LC. So that I can transfer that to Ching. My bank, People's Bank, will never transfer an LC unless it clearly says transferable. That is what the UCP 600 LCs are. Like I said, the ICC rules for 522 for collections, there is a thing called UCP, LCs are subject to UCP 600, right? UCP 600. That is it. So, according to UCP, it also covers how LCs are to be handled, like how collections are handled. The UCP covers how LCs are to be handled. Okay. So in that it says a transfer LC, a bank cannot transfer an LC to another bank unless the bank who is issuing, that is Bank of Ceylon, issues a transferable LC. So please tell your bank to put transferable LC. Also, in one of the conditions of LC, you know I don't have factory in Sri Lanka, right? So the LCs are manufactured in Singapore, right? So when you put shipment from normal LC will be shipment from Colombo to Maldives. If it's a product from Sri Lanka, Colombo to Maldives, right? But since it's going to be from Singapore, your LC must say shipment from Singapore to Maldives. No need to come to Sri Lanka, straight away to Maldives. Right? Now what happens is, so Ali says, right? And they open a LC. Ali opens a LC. Okay. Now the LC is, we'll say $10 for this example, right? And AC is $10. So the total value will be $100. Can you see? Number one, number two. Just follow this. $100. It has come to People's Bank. Right? People's Bank is advising the LC to number three. Advising. Hello, Mr. Banda. There's LC for you from number three. There. From Ali through his bank. Bank of Ceylon Male for $100. Covering 10 ACs at the rate of $10 a AC. Right? Can you see that? Okay. Now, having said that, then comes, now the Ali has to get the Banda has to get the ACs from Ching. It's a transferable LC. What he will say is, what Banda will say is, he will tell People's Bank, please transfer this LC to Mr. Ching in Singapore, with the Standard Chartered in Singapore. This is the bank, right? So in this LC, the first beneficiary, first person who benefits is the known as first beneficiary, that is the Banda. Now he's telling People's Bank to transfer the LC. But if he transfers the full LC, $100, when Singapore Ching ships the goods, he will get $100 from Maldives. What is he get? He gets nothing. Right. But Ching has agreed whatever AC that he gives to Banda, he will sell at $8. So what Banda does, he just transfers the LC, but transfer only for $80. 10 ACs, $8. It is transferring, right? So transfer done, $8. Now Standard Chartered got it. Now when second beneficiary gets the advice LC, he is getting it for $80. Got 8 to 10. And then he is supposed to ship the goods. He is supposed to make the shipment from Singapore to Maldives. All that is okay. Right? What he does is, he got the LC, he is happy, he does the shipment. Okay. He does the shipment. He manufactures good quality, high quality. 10 ACs, he has sent it to the ship goes to Singapore, or to Maldives from Singapore. Now, what happens is this, now the BL and the invoice and the origin, we'll talk about those three documents will be sent to, under transaction comes to the first beneficiary. Here second is sending. So what will be the invoice value? $80. So numbers $8, right? And it comes to People's Bank again. People's Bank, right? This Standard Chartered Bank is bank. He gives the documents to his bank, and he's now in the Standard Chartered Bank, Singapore. They are sending it to People's Bank. Right? See, $8. Saw that. So now they've got documents for $8. Invoice is $8. Whose invoice is this? This is the invoice of Ching. But in the LC, who is the beneficiary? Whose invoice is LC calling for? What is the LC that, what is the invoice that Ali wants? Ali wants the invoice of Banda. So what Banda does is, once they inform Banda, right? Once they inform Banda, what he will do is, that invoice of Ching for $80, remember I'm telling you, from $80 it came here, this invoice issued by Ching, they will remove that. People's Bank remove it and tell Banda to give his invoice. How much will be his invoice? For $100, right? 10 into 10. He's selling 10 rupees only. So he'll put that, change that invoice to $100, do that, and they will send the documents to Bank of Ceylon, Mali. For how much? $100. He opened the LC for 100, got invoice 100. Beneficiary in the LC is Ali, Banda. So write Banda, right? What? So when LC Shim Bank gets the LC for $100, either they can tell debit Ali's account and send the money to Banda. But if Ali has no money, it does not matter. Bank of Ceylon has to be. I told LC undertaking, no, between the, it does not matter whether Ali has money or not, right? So the Bank of Ceylon will, their funds or debit Ali's account and send $100 to Sri Lanka, right? To People's Bank. Once Sri Lanka gets the $100, they will send the $100. Once they get the $100, what was the amount that Singapore guy gave? $80. So he 80. So he will send this $80 in payment to the Singapore guy. Okay. So then the Singapore person usually gets the $80. He got the $80. $8 came in. Now the balance $20 will be credited to the Banda's account. So this is the transaction of a transferable LC. Banda is acting like a middleman, right? He negotiates with Ali for $100, 10 ACs, negotiates with Ching for 10 ACs, $80, gets an transferable LC done through Ali from Bank of Ceylon and then transfer it to Ali to Ching for 80, pays Ching 80 and he gets 20. This is what you get transfer LC. Right? Now, a few things on this. Actually, good for you to know. Now, in this case, when the LC comes here from People's Bank to Standard Chartered, second beneficiary, that is Ching, is performing on, because this is very important for the next one, right? Ching is performing on whose LC? Transferable, no? So basically, the Bank of Ceylon LC of Maldives is transferred to Ching. So, what did People's Bank do? People's Bank is known as the transferring bank. They transferred the Bank of Ceylon Mali LC to Ching, to the Bank of Standard. So whatever guarantee, whatever assurances that Ching will have of payment is under the transferred Bank of Ceylon LC of Mali, not of People's Bank. People's Bank was only a transferring bank. You understand? People's Bank was only a transferring bank. So the Ching has no right to claim money from People's Bank. If he claims, People's Bank will tell, look here, my friend, I am only a transferring bank. I just transferred to you the Bank of Ceylon Mali LC. Right? So, whatever payment that you will get, guarantee, whatever guarantee for payment is from the Bank of Ceylon Mali LC and not from me. And also remember, I will pay your $80, right? Your $80 down here sent here, only if I get the money from People's Bank or from Bank of Ceylon Mali. I am not, People's Bank Sri Lanka is not obliged to pay. Only transferring bank. So no exposure for. So when Banda comes and tells them transfer LC, there is no exposure for People's Bank. They can do it. But think of the case if Banda tells, forget about this part, forget about Maldives, forget about this part. Say, Banda comes, wants to import something from Ching and tells People's Bank, open LC for Ching. So when People's Bank issues an LC, then beneficiary Ching is depending on People's Bank LC. So People's Bank is obliged to pay Ching even if Banda doesn't have money. Right? But under transferred LC, no. People's Bank merely plays the role of a transferring bank. Right? So this is the difference. If Banda told to open LC, then there is exposure. Then you have to discuss with Banda, see what is you want to deposit cash, how is credit worthiness, whether you have property, that this, blah blah, everything you have to go. But if Banda is transfer LC, what's your problem? You just transfer it. Right? I will come to a commission, you make a lot of commission on this, but we don't talk about that. But so this is how. Now if you transfer this LC, showing the applicant as Ali, okay, then and his address, then Ching will know who Ali is. The next time what will he do? He will, he has the address, importer's name is there, applicant, he'll write to Ali and say, Ali, how much did Banda sell the he charged me $10. Really? Okay, if he charge you $10, So I gave to one that $8. Don't worry, Ali. I will give you a AC for 875. You send me the LC direct. King is saying, Mr. Ali, you open the LC direct to my bank, Standard Chartered. Don't go to bank, People's Bank, don't go to Banda. Then Banda will lose the business. Right? Okay. So, very important for Banda to ensure that Singh does know who Ali is. So, when transferring, you get the applicant's name, no? Normal LC applicant name will be Ali, no? He's the one is opening LC. And beneficiary or exporter will be Banda. So, when transferring the LC, what People's Bank will do is, they will put the applicant's name instead of Ali, they will put Banda and his address. Alam address, right? Lanka address. And second beneficiary, in the original LC, beneficiary is Banda, no, the exporter. They will put the name of Ching. Right. So when Ching gets the LC, for him the applicant is Banda, although it is Bank of Sri Lanka LC, they have changed the name of the applicant to Banda and changed the name of the exporter to Ching. Whereas in the original LC, importer is Ali and exporter is Banda. So when Ching gets the LC, he cannot see Ali's name. Right. Similarly, when it comes to documentation, here, he gives invoice, $80 invoice. Comes here now. Now, if you send the Ali's, if you send Ching's invoice to Ali, what will happen? Ali will say, oh, so this guy is buying from Ching at $80 and he's selling to me at $100. That means buying $8 and give you $10. Right. Now Ching invoice there, his company name all there. I will write to Ching straight away. And I will write, tell Ching, here I got your invoice, you are getting to ask your money from Banda at $8, right? And he's selling to me $10. Don't worry, you send to me direct. I'll pay you $850. Right? Then again, Banda will lose the business, right? So what Banda does is, when it comes to People's Bank, the Ching's invoice, he will remove that invoice. First thing, it is for low value. Second thing, Ching's name is there. So he'll remove that commercial invoice and then put his own invoice, Banda. So when Ali gets the documents, Ali sees Banda's invoice for $100 and not Ching's invoice for $80. That way, he has kept Ali without disclosing who Ching is. And he has kept Ching by changing the applicant's name without showing who Ali is. So by this, he maintains his middleman status, right? So that is actually, I can go more detail on this, but not required. So knowledge of this is enough as to what a transferable LC is. Now I have to touch you on back to back. These are the same thing. Now, in an article, in the UCP article, you get articles, right? Here, you article, you get here, right? This is the article that relates to Article 38 of UCP, only relates to all transferable. What is it? You can see change the name, all that is here. Transfer may be available, offer space, right? Okay, all these are the terms. In that one comes transfer again must, and when you're transferring, if the LC is asking for ACs, when transferring to Ching, Banda can't make it fans. Right? There are only certain items of the original LC that Ali sent that a bank, when a transferring bank can change. That is the amount of the credit, unit price, like the amount was $100, right? All these items here can be changed, can be reduced or curtailed, right? Understand? So therefore, you can have, of course, you won't transfer to, you won't get $200 and ask from Ali $100, no, that won't happen. So all this can be reduced, right? Here the name of the beneficiary may be substituted, that is the applicant is the credit. Yeah, that's all. I told that change the name from Ali to Banda, right? So okay, now that is the article. These are this knowledge is enough. These are items that you can change. What are the you can change, you can reduce. What are the items? Article 39, 38G says these items can be reduced when transferring LC. Right. Okay. Right. Okay. Now we go to back to back. Back to back is now here there's a big difference. Okay. Same example, right? But in back to back, what happens? Same story, yeah? Air condition, everything. But only hitch here is certain countries they don't allow transfer LCs. Okay. Because say the exporter is Banda, right? They do a search on him and find Banda is a good customer, a good company, all that blah 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 they got. But the person going to ship his thing, how do you know how Ching is going to be? Third party. So certain countries are very strict that you cannot, regulation don't permit, don't worry about that. Just assume that certain countries, they don't allow transfer LCs. Right? So what Banda does is here, unlike coming and telling People's Bank, I'll make it short, huh? Unlike coming and telling People's Bank, please transfer my LC. Can't transfer, no. Bank of Ceylon, Malay, now in this country, regulation cannot do transfer LC. So it will not say transferable. But Ching wants an LC. Ching wants an LC. How to do it? So the Banda will come to his bank and tell the bank manager, look here. I have got an LC from Bank of Ceylon, Mali for $100. 10 LCs at $10. Right? It's a LC. Bank guarantee. You can see it. Right? So, but I have to get these AC shipped from Singapore to my supplies in Singapore. Right? But he won't do that without an LC. Now I can't transfer LC of bank account, but it doesn't allow transfer. So the branch manager, okay, what do you want me to do? I only want I want to assure you, if I supply 10 ACs under this Bank of Ceylon Addis LC, I get $100. Right? I want you to open an LC to Ching just for $80 to supply some ACs to Ali in Maldives. Right? So once Ching sends just a shipment and I submit documents, Ali will pay me $100, right? Okay, Ali will pay me $100. You paid $80 to Ching. You take the $80 and give me $20 because you're asking me. This is a guaranteed payment for you. You see, Bank of Ceylon, Mali has given this. You are sure of the payment. So please open an LC for $80 to Ching. You have a good backing. See, on the backing, you are back to back. On the backing of the Bank of Ceylon LC for $100, on the backing, right? On the standing or against this LC, I am asking you to open another LC for $80 because you are sure that once Ching sends the goods there, I can give the invoice, like I did change the invoice $100 and get the money from Bank of Ceylon. Right? Now here is not, now the position of People's Bank is not like transferring bank. Transferring bank, no problem, nothing, no exposure to bank. Now here you understand that supposing People's Bank opens an LC to Ching, right? And Ching gets the LC. Now what LC will be Ching getting through his bank? Is it going to be Bank of Ceylon Malay? No, that's not a transfer LC. it will be a LC of People's Bank. People's Bank is opening an LC for $80 to Ching. So now if Ching shifts, right? Same sequence or down in same sequence. If Ching shifts and sends the documents for $80, right, to People's Bank, right? People's Bank cannot say that I will pay you when I get the money under LC of Maldives, because Ching does know it's not transferred, right? That has got nothing to do with Ching. If the People's Bank gets the $80 documents, the People's Bank has to make the payment to Ching, irrespective of whether the documents Bank of Ceylon will pay or not. Anything can happen by the time you pay. Documents came, $8 paid. Now you are claiming from People's Bank, from Bank of Ceylon, Mali. So there is no guarantee, like I told you, country situation, bank, geographical location, geographical conditions, cyclones, that is everything. Common factor, right? There can be cyclone, typhoon, the islands being thrown off, right? So there is no guarantee for People's Bank that they will get the money from Bank of Ceylon. You have comfort, you see, you take a calculated risk, right? If you are doing it, you are taking a risk. You are taking a risk on Bank of Ceylon and Maldives. You are depending on Maldives and depending on Bank of Ceylon to get the money. On pending that risk, what are you doing? You issued an LC to Ching. Ching has submit documents, you have to pay it. Banda doesn't have anything. Banda only told you, I only have this LC from Maldives. So you are sure to get the money from them. On that you open. You can go to Banda. Banda has no account, Banda has no property, Banda got nothing. Right? Are you going to open an LC on the assurance of Bank of Ceylon or not? You understand? So with that condition, see the difference. Transferable LC, Banda's Bank, People's Bank does not take a risk, just transferring. But if it is back to back, People's Bank on the backing of the LC of Bank of Ceylon Male is opening another LC, is opening their own LC to Ching, right? So when Ching pays, submit document, Bank of People's Bank has to pay. So this is the difference between back to back and transferable. In transferable, Banda's Bank does not take any risk, just transfer, because ultimately Ching is performing under the transferred LC. But back to back, it is independent. It is Bank of Ceylon LC is independent of the People's Bank LC. Ching has to be paid. After that, you take a risk. As I said, Banda has to open the LC for them, depending for money to be paid only from the Bank of Ceylon LC. Right? Nothing else. He has nothing. Banda has nothing. Right? So supposing you don't get money from Maldives due to country situation, bank situation, geographical condition, weather condition, this, that, tsunami, that, this, whatever, right? Then of course you run a risk. So when it comes back to back, then and that means now transfer LC, you don't have to put exposure under him, no, nothing. You are sending the LC, they pay. If Bank of Ceylon pays you pay Ching. Other you don't pay Ching. You don't know exposure Ching. You're told Ching, transfer LC, you give me documents, I'll send to Bank of Ceylon, you'll get the money, right? But under back to back, you're taking your own independent exposure on the backing of the bank. So therefore, you have to assess the situation, study the bank, study this, and think. Sometimes you might tell Banda, no Banda, this is a bit risky. I'll tell you, I'll go 50%. You deposit 50% of the LC. Deposit $80 now I'm going to open LC, right? You deposit $40. Balance $40, I may take a risk on bankers loan, right? Or say something like Somali or somewhere, you'll not take it. They don't know, I can't. Back to back, I can't. My God, I'm not sure that I get the money from Somalian bank or whatever, right? Standard Chartered Bank London. Right, okay, that's good. No problem. I'll open that. It depends. There I told you, country and the bank depends on that. So back to back, you run your own exposure. You are independent. Anyway, you have to pay. Transparency, you just transfer. So in most cases, these customers come and ask you for back to back, right? My experience, I feel that when you say back to back, you ask them first of all, did you tell them, ask them whether they can open transfer balances? Some cases they are not. Then they go back to customer, no, our bank says can't back to back. Can you transfer? Yes, I can. They are not asked. So don't miss the opportunity. So check whether if transfer can be done, then you can go transfer. Totally rejecting and saying I can't. Look at the avenue of taking a transfer balance. Then you don't have exposure, right? Some customers they don't even ask whether they can transfer, right? Later, when they say, yes, I'll go and try that. Then they say, yes, they can. Then they open a transfer. In vain, others you have taken unwanted exposure, right? So that is the difference between a back-to-back LC and a transfer LC, right? With that, I finish the LC type, right? Irrevocable, confirm LC, revolving LC, red clause LC, standby LC, transfer LC, and back-to-back LC, right? Now we go to some of the, these are loans, right? Now when there are various loans that you can get in trade. You can get an export loan, get pre-shipment loans. You get for this is pre-shipment loan means you have a export order and you want to do the shipment, so you go to a bank and ask them for a loan. Pre-shipment, before shipping, you ask a loan. In Sri Lanka, an exporter can get a loan in dollars because dollar rates are low, right? But now because dollar rates are rupee almost the same, and one time it was dollar rates were higher than even rupee rates. But generally, we are extraordinary situations. Normally the dollar rate in market, international market is low. So to help the exporters, banks allow loans to be borrowed in dollars. This is for pre-shipment, right? Pre-shipment loans, right? Export. Then you get post-shipment loans. Like I told you, here ship the goods are gone. Now you get a period of say 60-90 days for the importer to pay. But in the meantime, he wants the money, right? Then that is what you call post-shipment credit, right? After shipping the goods, you give him a loan, pending money from the importer. That's what you call that, right? Then you get import loans. These you get related to import. You open an LC. Customer says, look here, I want to open an LC, right, to import cars, right? Now you can't import cars, right? We'll say to import some building materials, for example, right? Some building materials. But I can't pay because when I import and bring to Sri Lanka, I have to sell it and give it on credit. It takes me about 3 months to sell my goods and get the money. But my importer, he's asking money immediately. So what the bank does is they open an LC, right? And then when the exporter submits documents, they pay him immediately. Okay. Now the exposure they paid, the customer exposure has to be shown somewhere. No? So what they do is they give a loan to him. That loan, that what they are paid, say $110,000, they are paid, they put it into a loan. He says he takes 3 months to pay his cycle, working capital cycle 3 months. Then what they do is they give a 3-month import loan, right? Pledge loan is, now import loan means he takes the goods straight from the port, he takes it and sells it, right? And we give a loan. But we don't have control, bank doesn't have control of the goods. But pledge loan, you grant open LC, you pay the export immediately, but you have control of the goods in the sense that you lock the goods under control. Usually it is a well control between you and the customer, and what he does is As and when he needs raw materials, say yes, you have released him today $10,000 worth of raw materials, right? Okay, you take. Then he comes and pays the 10,000. Then both of you will take the keys, go to the where we lodge the goods, open the doors and release another 10,000. Then he manufactures, sells, and comes in this. Now, what happens? Why the pledge loan happens is sometimes the importers, manufacturers, they import large quantities because they get a good price. But that amount is enough for them for shipment to do that raw material required for another 10 months. But since the price is good, they import in bulk. And as and when they require, the bank comes and releases and they do a shipment. Okay, they sell shipment, local or even export or whatever. They sell it, they get the money, then they want again to manufacture, they come and pay. So they pay that. So they, sometimes when importers order in bulk, get a good price, they can't dispose of it immediately, no. So they take the bank, do it on a pledge loan basis, lock it up, and then the bank, as and when they pay, the bank releases. That is how pledge loan is, right? Right, friends, that is about letters of credit. Now I have to cover to you, what do you call this? I have to cover Incoterms. Okay. Can you see this? Can you see this?
Yes. Yes.
Okay, thank you. Right.
Yes, sir.
Now, this is, I'm going to be very brief. This is not in your level and your exposure mainly concerns the core trade departments who are handling trade. But like I said, general knowledge is very generalized knowledge is very important. Okay, now we focus on payment methods, advance payment, open account, document collection, document credit, all that you know. But these are terms of trade. Now, so what happens? Now, when you take a person from Norelia, right? He manufactures something, okay? Then what has he got to do? He has to carry the goods, say load it. Assume what happens, goods are loaded on the, don't worry who is loading, with the import export, don't worry, right? Goods have to be loaded into a truck, brought down to Colombo, shipped put onto a ship. The ship has to go to, we'll say, this is going to, we'll say, it's a Middle East shipment, right? Ship has to go to Jeddah. Those how they know Jeddah is a port, right? And Riyadh is a landlocked area, right? And go to Jeddah, unload in Jeddah, again put in trucks and take to Riyadh. Okay? From Norelia to Riyadh, what happens? Norelia to Colombo by truck, Colombo to Jeddah by sea, then Jeddah by truck to Riyadh. Okay, that's how it goes. Now, in doing these things, when you take the goods, there are so many things involved, but basically Incoterms deals, right? When a person is taking a lorry hire from Norelia to Colombo, who is going to pay that? Is it the importer or the exporter? Right? Please, I know generally you say, what is he talking? We export his weight. Now wait, let me show you what it is, right? Please wait. Then when he puts it on the ship from Colombo to Jeddah, the captain asks a fee, no, to take the goods to Jeddah, right? Who is going to pay that fee? That is known as freight, right? Who will pay that? Okay, you call it freight or carriage. Carriage, cost of carriage is cost of freight. You call it freight and carriage both same. Carriage you carrying it, right? Or the cost of carrying. Then in Jeddah, it has to go to Riyadh. Who will pay for the truck there? Right. Then comes, maybe you're exporting. Who has to take the export license? If you're exporting from here, who has to take the export license? There are items you have to take export license to send from Sri Lanka. Who will get the export license? They are the importing country. Import company will want some licenses. Certain items will be under license. Who will get the import license? Right? That is decided. Right? Then costs, like I told you, whether one exporter pays for the freight from here, for the lorry from here to Colombo, and the importer pays for the freight from shipping freight from Colombo to Jeddah, and then from Jeddah to Riyadh, does the importer pay, right? Then that is decided, right? Then also, right, now you're taking the goods in the lorry. These are actually the main two items are these. Explain the division of cost between the parties and the division risk. These are the two main items you need to know. And don't worry, I'll be quite, it's simple. It's just, I told you, I'll be running generally, right? Now, risk. Now you're putting the truck in from, when you're putting a truck in the, no really say the exporter's warehouse. While loading the truck, right? Say that air conditioners, the manufacturer is selling air conditioners fall and break from the lorry. Whose risk is it? Who has replaced? Is the exporter or the importer? While going to Colombo, Kadugana, there's a slip and the lorry carrying the ACs go down the hill and get damaged. The lorry topples. Then what happens? Who is responsible? Then you go to the port. While in the port, you're taking the goods and putting it onto the ship. You know the ship, and between the ship and the port, or the key, you call the key, right? Where we go and put the goods, and the ship comes and stops itself alongside the key, parks itself along the key, right? Then between the ship and the key, there's a gap, water. While loading it into the ship, the ACs, the whatever, the crane breaks down and all the ACs fall into the water. So whose risk is that? Whose cost is that? Who has replaced? Importer or exporter? While going by ship from Colombo to Jeddah in India or somewhere, another ship comes and crashes the ship, right? And all the goods perish. Then who is responsible? Okay. Then while unloading in Jeddah, between the ship and the key, there is a gap. Okay. All the ACs fall into the water. Then who is responsible? Right? Importer, exporter. Then after loading the trucks, he's taken to Riyadh. As you know, like we are every day we have the elephant conflict we see in the TV, right? Elephant. My God, it's a terrible thing to look at. Similarly, in Riyadh, in Saudi Arabia, what do you get? You don't get elephants there. What do you get? You get camels, right? And camels are very, very strong. So you're going by truck. Camels come and you go, and you can't, the speeds that you go, say from Jeddah to Riyadh, about 1,000 kilometers, and you go in about 3 hours, right? 3 to 4 hours you can go. So you're going at about 180 kilometers, your speed is. And a whole lot of camels are already crossing the road. And you go and crash in the camels. All the ACs break and it crashes. Then who is responsible? Right? Now like that, okay. And then, okay, you take it, you say, to the warehouse of the importer. While unloading at the warehouse of the importer, the goods break. Then who is responsible? All this, and who pays for this, is what Incoterms is about. So I'll just show you. Now 2000, in year 2000, there were 13 terms, right? In 2010, they revised it and made it 11 terms. And in 2020, they changed and 11 terms, but there was a small change like this. All the same, but the latest revision 2020, DAT became DPU, right? Don't worry about more details. But now you see, my God, 1, 2, 3, 4, 11. By the time you finish 11, give me 3 o'clock. No, don't worry. I said I'm going to only give brief. So don't worry. I'll finish. But don't think, how can you finish so fast? But see how I do it, right? It's, as I said, it's a detailed study, but that's not required. I'll just start with this, right? Now, when you say EXW, X works. FCA is free carrier. Carriage paid. Carriage means freight paid up to where? Carriage paid. Paid and insurance. This CIP means carriage is paid, insurance paid, plus freight is paid. Delivered at place. DP delivered at place, unloaded. Okay. What it means is, delivered at place means it is delivered at the importer's. Now, if it's the importer in Riyadh, but the truck goes there. I can remember. I told who is responsible. He goes there and his truck is parked there. Okay. But he will not take the risk of unloading. Right? Here he takes the risk of unloading. Unloaded. Right? Okay. Then delivery duty paid. Like, okay, now we'll go for this, right? X works start. X works means, now all this you can go and read, but I'll basically tell you what it is. X works means this is at the New Area warehouse. at the warehouse or whatever place where the goods are manufactured by the exporter. When the import export now they understand payment methods. No, you and I will do open account, all that blah blah. That is agreed. Now, what is the terms of trade? These are terms of trade. What is the trade? He said, okay, we'll work on X works. So what does that mean? X works means basically, why I'm saying I can go fast is each one is connected to the other, only a small difference between each other. That's why I can go fast. You see it, right? X works means the exporter keeps the goods ready at his warehouse in whatever place, and that is all. That means he has delivered the goods. He has done his job. The main point here is that in each trade term, right, you find out what is the delivery point. Once the delivery point is, as an export has done deliver the goods according to the term, from that delivery point onwards, the responsibility, the risk goes on to the buyer, right? Until delivery is done, it is the exporter, and once delivery is done, it is the importer. But then, what is the point of delivery? That is what you're asking, right? So in Xworks, the delivery point is at the premises of the exporter. Now you wonder what that means. That means the exporter, once he has kept the goods manufactured and ready and told the importer, look here, Mr. Riyadh, Mr. Ali from Riyadh, I have done my delivery. My goods are available for you to come and collect. So they have agreed that if they are working on Xworks, from the time the exporter has manufactured the goods up to Riyadh, whatever that may happen, right? Whatever that may happen, whether it's toppling down Harganna or loading onto the truck in the premises, or ship is crashing, or camels are crashing, falling into the water, nothing doing. All that risk is taken by the importer. The delivery point for the exporter is only keeping goods available at his premises. So that is the best trade term for him, safest. Once he has done, yes, you see down here, X works represents the minimum obligation of the seller. Minimum. Just keep it, and that means just delivery. So importer agrees. Depending on demand, exporter, no, I can't do anything. You just come and take. My delivery done. Once you're done, I come you pay my money. Okay? In the method we agree. So X work is that. Exporter just keeps it ready, and importer comes in. From there onwards, right up to Riyadh, it's all his problem, how he takes it, how he does it, all that, right? Then free carrier, right? Now here, if normally a person has to take the goods from the exporter's warehouse to, if you put it on a ship, you have to go to Colombo, no, right? This is Colombo for the moment, right? Or whatever, Colombo will say for the moment, right? Now, exporter says, no, I can't. I can't take the goods to Colombo. But I can do this to you. You tell me to go and hand it over to somebody up to Kandy. Anyway, between Kandy and Noorela, I'll do it. Beyond that, I can't come, right? I have no other work. So, there are, you get the container yards, have you seen? You get in all these roads when you go to Kandy, when you go to Igamo side, when you go Australia, you see certain places, a lot of containers are stacked. Those are container yards. So, those are the representatives for carriers, for shippers, right? For shipping companies. So they agree with, say, for example, just it can be anywhere, right? It doesn't have to be container yard, but for explanation I'm telling you. So under FCA, the exporter agrees that there is a container yard in Gampala, right? He says, I will go and hand over to the person at Gampala. Okay. So the delivery point for the export under FCA, not like Xworks where it is at the premises of the exporter. The delivery point for the FCA is the exporter has to take the goods and bring it to Gampala and hand it over to the container. That's how they agreed. Then his delivery is over. That is the delivery point. So bringing from Nuwara to Gampala is the risk of the exporter, right? But from Gampala up to Riyadh, everything is on the importer. That is what we call FCA, right? Sometimes they say, I can't come to Colombo. There are containers, I hand over. That's why you get all over places, you get containers, convenient for the exporter to come and hand over. So FCA, he brings and gives you the carrier, they agreed, right? I took the Gampala container as just an example. We can somebody can be somebody else even, right? It does not matter, right? That is what you call FCA. Then CPT, right, means here come. Wait. Sorry. Now here, small difference from FCA. Very small difference. CPT means now he brought it to Gampala, he handed over. Delivery done. Right? Like FCA. Delivery point, CPT, FCA both are same. Gampala will say not only Gampala, I'm just saying example Gampala. Whatever they agreed place, right? Agreed person or carrier. Then now in FCA, the export doesn't pay anything now, any other charges. But in CPT, whatever the cost of taking the goods from Gampala to Colombo is shipped to Jeddah to Riyadh is borne by the freight charges or carriage charges. Carriage means freight, right? What a cost. Those transport costs, like what you can say, transport like, has to be borne by the seller. If delivery point, yes. Which means if it's delivered at Gampala, like FCA, all risks, whatever happens to the lorry, whatever happens to the ship, whatever happens to the trucks in there is to the seller. In FCA, is no. Once the delivery is done, after that, from Gampala to Colombo, Jeddah, Riyadh, whatever the risk is, all to the seller. Even in this, even though the seller is paying the transport, right? All the seller is paying the transport from Gampala to Riyadh, any risk in between is still borne by to the seller's account because the delivery point is in Gampala, right? That finishes that. Then carriage insurance paid to. What does this mean? Same, little small difference. Now you said FCA, I said FCA delivery point is Gampala container, right? He does not pay the freight. Then you can cover insurance, no? From Gampala right up to Riyadh, anything can happen, you can have insurance cover, right? Insurance cover, right? Okay. Now, if they agree your delivery point is Gampala container plus the exporter has to pay freight from Gampala to Riyadh, right? Like lorry from Gampala, Colombo, Jeddah, ship to Jeddah to transport has to be borne by the seller. That is CPT, right? Carriage paid to. Without this part, carriage paid to, not insurance. If it is CIP, right, then the exporter, in addition to coming and giving the goods at Gampala, pays the freight from Gampala to Riyadh, okay, and also takes the insurance policy, covers insurance from Gampala to Riyadh. So that if anything happens in between, the seller should have taken insurance policy. But it's not the responsibility. Not accident happens, not the responsibility. He can do what he wants. If the ship sinks, either the importer can just keep quiet. He can do whatever he wants. But the only help the exporter has done is he has given him an insurance policy. He has covered insurance, and he tells the importer, here, my friend, and maybe at Gampala handing over, here is the insurance policy. Here is the freight. I have paid all the freight up to there. After that, risk of the goods is yours. There can be some risks that are not covered under the policy. That's not the problem, right? Whatever happens good, the risk is of the importer. But only thing in CIP is he only got an insurance cover. Getting the insurance cover does not mean the risk is the sellers. Only getting the policy under CIP is known as CIP. But the risk factor is same as FCA. The moment he hands it over to the container yard in Gampala, the risk right up to Riyadh is for the importer. CPT, delivery point is a container yard Gampala. From there right up to Riyadh is the risk of the importer, but the exporter only pays the freight. In CIP, again, handed over at Gampala, paid, that is delivery point is there, then risk is transferred to the importer, but the exporter has paid the freight and taken insurance policy. That's all. But the risk is still with the importer. Once delivery is done, they decide on delivery point. That's it. Risk transfer. It will never change whatever we done right now. Okay. Now DAP. Now here in all these terms, you get the E terms, F terms, C terms, and D terms. In D terms, remember, all D terms means nothing is happening within the port of Colombo, right? Nothing in the exporter's country. All happens in the importer's country. D means delivery at that site. Now, for example, here means the seller demands the goods are placed at the. Now here, when you say delivery, it does not mean Colombo, it does not mean Gampana, nothing. It is meaning that a delivery point they deliver at where? In Saudi Arabia. Understand? At Saudi Arabia. Say somewhere in, he may be from Riyadh, but somewhere in Riyadh, some town in Riyadh. And you all don't know towns in Riyadh, no, some place in Riyadh, right? So here in DAP, the exporter's delivery point is in the country of the importer. The Riyadh means somewhere in Riyadh. So until the goods go to the delivery, that is from Nuwara to Colombo, Colombo to Jeddah, Jeddah to that particular point in Riyadh, the risk is of the exporter. The delivery point is in the importer's country. All D terms are importer's country, right? But here, see here delivery ready for unloading, So when he takes it to that particular point, right, he does not unload from the truck. While unloading, when anything happens, that is responsible to the importer. He just keeps it, and the responsible of unloading is for the importer. Unloading, ready for unloading. Understand? Okay, that's done, huh? Then comes DPU. Now here, DPU small difference, same thing like I told you, but here in D, you see the previous one, ready for unloading, not yet unloaded. So risk unloading is on the importer, right? In DPU, here you take it there and you unload it. Here the exporter has to take it to the point in Riyadh, wherever, and also unload it. Understand? Even the unloading is done by the exporter. While unloading there, if anything happens, after unloading only, delivery is considered. They are in the DAP before unloading. So once you have kept it ready for unloading, delivery is done. So unloading is the risk of the importer. But here in DPU, he has to unload the goods. So until it's fully unloaded, if anything happens, it is exporter risk, right? That's the difference. Then comes the DDP, means here is the most convenient thing to the seller. Bringing the goods all the way from Nuwara right up to the premises of the importer. He doesn't do anything. Duty, clearance, export clearance, import clearance, paying the duty, deliver duty paid, it says, right? Everything is done by the exporter, right? Okay, everything done by the exporter, and he has to bring it to the exporter, right? All the duty also has to be paid by whom? Has to be paid by the exporter. But remember, here again, after, let's say the importer is sitting in his premises, in his house or something, or what, his big garden, and an unloading point is that. But here again, remember, he will not unload. All of the cost, duty, everything has to be paid by the exporter. But here see, here again, he will not unload. Ready for unloading. Unloading risk again here goes to the importer. But he is not, right? Here exporter has to pay for import duty, pay duty for everything, whatever. Export duty, import duty, anything. All charges are paid by the exporter. But here, duty paid means they paid all the duty, and here unloading, but ready for unloading. Unloading list is for the importer, right? Then comes FA. This term is not very popularly used, right? It's not a common thing. Where in rare cases you get that FA is, I don't know, only D terms are in the importer's country, right? Whereas all other terms are in the exporter's country. FAS means the exporter delivery point is he takes it to the port or where place near the ship, and there are identified, say there are certain areas in the port, and he delivers the goods at alongside the vessel. Okay, he doesn't only to just take it, and he doesn't put it on the ship. He doesn't have to put it on the ship. Only alongside, he goes and delivers along. But this is a very rare situation. Normally it doesn't happen, not commonly used. Where these two agree that the goods, because maybe the loading has to be done on a special equipment or something like that, and equipments are not available all the time, right? So maybe only specialties they do these cranes or whatever. So what happens is exporter can't wait. Exporter, okay, I will take it and go and unload it at the port, right, alongside the ship. You have to what? Get it loaded. That they agree. So that is a phase. So then the delivery point is going and unloading the goods alongside the ship in the port. And after that, once that is done, the risk transfers to the importer, right? That is right. Right. Now FOB, remember CFA, FCA, remember FCA, no? Can FCA? Same as that one, this was no difference. Here only difference is, instead of handing it over to somebody in Gampala, you bring it all the way to Colombo, right? And put it on board the ship. You load it onto the ship. So while loading onto the ship, and if the goods fall in between the ship and the water, still you are not done your job. Still it is not on board. So you have to take risk and put it on board the ship, and then only your duty is complete, right? Now in D terms, when you take it to Jeddah, and if the goods fall into the water, still it's your responsibility, exporter responsibility. Why? Because D term, the delivery point is in some destination Riyadh. So if the goods fall in D terms, if the goods fall in Jeddah port between the ship and the water, key and the ship, then the water, then still is exporter. Because it is D term is somewhere in Riyadh. So it cannot a complete delivery point. Right. So in free on board, he loads the ship onto the goods on the ship, on board the ship, and then onwards, nothing doing. That's all. He comes home, ship catches fire, ship sinks overnight, nothing doing. Export is not responsible. He has done his job. He has put it on board. Right? That is export. FCA, he hands it to a forwarder or a carrier or whoever party they agreed, right? Freight, like I said, container yard, whatever, he hands over there. But FOB, he has been to Colombo and loaded on the ship. Okay? Then, but he doesn't pay for any freight from Colombo to Jeddah or Jeddah to Riyadh. Doesn't pay any freight, right? He doesn't pay any freight. Does he pay the freight from Nooreli to Colombo? You're confused. Obviously, no. His delivery point is he had to put it on top of the load it on the board the ship, no. So to bring to the ship, it is actually his cost, no. That's obvious. So we don't have to ask questions saying, in a FOB term, FOB term, right? Who pays the freight from Nooreli to Colombo? No point asking, because anyway the exporter's risk transfers only his job. FOB is he has to put it on board. So anyway he has to pay his cost and he has to bring it to Colombo. So it's very obvious it's his charge. But once he has put it on board, from Colombo to Jeddah or Jeddah to Riyadh is not his responsibility, right? No freight, no insurance. Now, cost and freight means same as FOB. You have to bring the goods, put it on board. FOB is there. Plus, this is actually FOB plus freight, right? Now, freight here means, right, he doesn't pay the freight to Riyadh. He pays the freight from Colombo to Jeddah, not to Riyadh, right? From there onwards, Riyadh, it has to be borne by the importer. So, delivery point is on board the ship in Colombo. After that, what happens to the ship, whether that night it sinks, or whether some people come crash in the Indian Ocean, or whether while before going to Jeddah it sinks, has got nothing to do with the exporter. The delivery point is on board the ship. Okay, so therefore by that is finished. But CFR is FOB, put the goods on ship. Yes, that's done. Delivery point is same. Only difference is he pays the freight from Colombo to Jeddah, right? And then comes the CIF, like CIP. Can you remember? FCA plus freight plus insurance, like that. Delivery point in CIF, he comes, he puts the goods on board the ship. That's delivery is done. That's the delivery point on board the ship. And after that, whatever happens is not his concern. Whether the ship crashes in India or goes sinks before Jeddah or catches fire, nothing to do with the export, because his delivery point is same as FOB, putting the goods on board the ship, right? But he has to pay the freight from Colombo to Jeddah. Also, take an insurance cover. Only take an insurance cover. Nothing to do with the risk. Risk is still the import. He has done the delivery now on board the ship. Nothing to. You can't, if the ship sinks, right? You can't go into the export. You give your good ship sink, replace the economy. You say no. My job was to pay the freight and give you an insurance policy. Here's the policy. You go and claim it for the company, insurance company. So when it comes to CIF, the exporter delivery point same as FOB on the ship in Colombo, right port. Then he pays the freight from Colombo to Jeddah, okay, and then also he takes insurance from Colombo to Jeddah. That is CIF, right? That you see, now you see how I was able to finish it fast, because every Incoterm was connected. The main factor what you need to know is what is the delivery point, and understand that once goods are delivered by the exporter and he has delivered goods at the point that is supposed to deliver, then all the risks transfer to the importer, right? And also when you say FOB or FCA, he doesn't pay for the freight. In FCA, he doesn't pay the freight from Kampala to Riyadh. Okay, neither will take insurance from Kampala to Riyadh. But if it is CPT, he has to deliver. He delivers at great point, say Kampala container yard, plus he pays the freight from Kampala up to Riyadh. But he does not cover insurance, right? But in CIP, he pays the freight. Same delivery point is container yard at Kampala. After that, this transfers to the importer, and then he pays the freight from Kampala to Riyadh, and also takes insurance from Kampala to Riyadh. FOB, put the goods on board, no paying freight, no paying insurance, nothing, right? But delivery point is on the ship, and all the risks transfer to the importer. Okay. Then CIF, right? CFR, what it does is, he FOB, same delivery, he transfers the goods transfer from the risk transfer from the exporter to the importer on board the ship, and then what happens? He pays the freight from Colombo up to Jeddah port. Jeddah port, Colombo port to Jeddah port, right? Then what is CIF? CIF is the FOB delivery point on board the ship, and then he pays the freight from Colombo to Jeddah, as well as covers insurance from Colombo to Jeddah. That's it for Incoterms, right, friends? That's about it for my trade. I hope. Now consider yourself from last week, okay, and see how you all feel. Your level of confidence from last week and with this week, these two, I hope it has enhanced your knowledge or ability or confidence in international trade. Apart from the exam, right? That is most important. Clear, guys? That's it then.